tech is still long-term leadership, but it's changing within.
You have investors sort of hopscotching back and forth between these themes.
We're going to continue to see these mini pockets of rotation.
This kind of digestion is completely normal, and frankly, we'd argue it's healthy.
Overall, it's still constructive for the entire AI trade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, shaking up the bull market, crude bouncing. President Trump says the ceasefire with Iran is over. Investors rotating out of chips, sending South Korea into a bear market as Amazon's $25 billion debt offering is receiving a cool reception. The test for sentiment is building.
There have been three cylinders of the rally so far this year. The first is inflation has peaked and is going lower, which potentially releases some of the pressure on the Fed. The second is that semiconductors are in endless demand and that a lot of the buyers are insatiable and price insensitive. And the third is that investors have insatiable demand for debt and investing in all things related to AI. All three of those being really challenged today with oil prices, with what's going on with semis, as well as this question of just what the tolerance is of bond investors.
Well, let's start with crude, and we can begin there. So a 6% move on crude, higher, WTI and Brent, and a 10 basis point move at the front end of European curves. That's the difference this morning, how the US bond market is responding to this development and how the European bond market is responding to this development. You'll see US 2s up 3, German 2s up 10. UK 2's up 11. There's a sense that one central bank is more likely to respond to this than another. And
Christine Lagarde hasn't really put that to bed with some of the ambiguous commentary. You could argue that Europe is in a much more difficult situation considering that they have a much more direct inflationary input. The U.S. is an oil price producer. But that said, a real question here as you start to see the front end start to tick up, are we seeing, especially after the labor market report last week, not stagflation, no one's going to ever accuse the stag in the story in the United States, but still a bit of a toxic brew heading into the July meeting.
2s at 420, 10s approaching 460, 30 stateside, comfortably through 5% now at the long end of the curve. Let's talk about this debt market. Amazon coming to market, offering at least $25 billion of debt. The reception was pretty cool. And they offered a concession as well. There was some real weakening, and you saw that weakening in other debt from other tech companies as well in the secondary market. I'm not going to say it was a full-blown pushback from this debt market, but just a little bit of what? Something to take note of.
Thank goodness, after more than $100 billion of debt from Amazon so far this year, there is a sense of a bit of discretion. This is no wholesale kind of abandonment of Amazon. Nonetheless, the fact that it was only twice oversubscribed versus 5 times oversubscribed from the deal from Amazon earlier this year, the fact that credit default swaps on Amazon are reaching some of the highest levels going back as long as that contract is, gives you a sense of how people are hedging against risk. Key question, why are they raising so much money? And ultimately, people say they have the cash, but why not raise it when they can? Again, all pointing to, is this the peak in borrowing conditions for some of these AI companies?
We're calling it the supply monster, and you're seeing it on the debt and the equity side. This was the debt story. In a few days' time, you'll see it on the equity side. SK Hynix coming to the US market, tapping capital markets here stateside. On the equity side of things for $28 billion. Speaking of South Korea, bear market. South Korea down 20%. Since late June. We've got the semis in America down 16% over the same period. It's difficult to make a big deal of that when you're up by more than 70% year to date on both the Philadelphia Semiconductor Index and the Kospi in South Korea.
I was going to say, this is the most yawn-worthy correction that you've ever seen, simply because people are like, well, what else is new? Kospi goes up really fast and it goes down really fast. Nonetheless, the fact that Samsung came out blowing out expectations yesterday with earnings, and their shares still were down about 9%, gives you a sense that this is a sort of indiscriminate selling and raises a question about whether the momentum trade is over. In other words, did the sort of parabolic move up, as Jonathan Krinsky say, have more to fall on the way down? Does it have to reverse?
What do we always say? You can learn something from the earnings. You can learn something from how the market responds to them. We learned something from how the market responds to those earnings on Samsung just yesterday. Equity futures this morning, we're down 1.5 on the Nasdaq. On the S&P, we're down by 1 whole percentage point. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research. As President Trump says the ceasefire is over, we'll speak to the former Deputy National Security Advisor, Victoria Coates, as the US blocks the sale of Iranian crude. And Tom Forte, as Amazon's latest AI debt binge draws a muted response. We begin this hour with our top story. The US and Iran trading fresh strikes. The president says the ceasefire is over.
To me, I think it's over. I don't want to deal with them and with this scum. As far as I'm concerned, it's over. I'll speak to our negotiators. They want to negotiate. They're good people. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. As far as I'm concerned, it's over.
Annmarie is travelling with the president in Ankara, Turkey, and joins us now for more. Good morning, Annmarie.
Good morning, John. Well, you heard it there from the President of the United States, basically saying for him, this ceasefire is over, though gave a little bit of a window potentially for his negotiators to continue talking to the Iranians. But he said that it has been a waste of time. And using some hot rhetoric, he called the Iranians, quote, scum and, quote, cuckoo when he talked about what is going on right now with the regime. Now, Jonathan, all of this stems from what happened yesterday. It started with Iran targeting 3 vessels. One of them was a Qatari LNG vessel. Another was a Saudi vessel. So the United States, in turn, had airstrikes targeting 80 facilities, strategic facilities for the Iranian regime. On top of that, revoking the waiver for that general license for the regime to be able to sell oil products on the open market. Iran has returned fire to some assets the United States has in Kuwait and Bahrain, and we are basically back to a kinetic war. And that is why today all of the focus at this NATO meeting in Ankara, Turkey, will be squarely focused on Iran. The NATO Secretary General this morning did say that he thought what the U.S. did was a necessary step.
Brent crude up 6% this morning, Annmarie. The good news, I guess, is we're not at triple digits. The story of the week, though, the story of the last month, is that Iran has repeatedly tested the patience of the president, and the president has looked the other way. Annmarie, at this NATO summit, why has the president chosen this moment at this time to start paying attention again?
Well, I think the Iranian regime is going to have this conversation about whether the defiance they want to have in the Strait of Hormuz is worth the cost of those oil sales. And potentially the president taking this moment could be for a number of reasons. One, they went after serious allies of the United States in the region, a Qatari LNG vessels. Qatar, of course, is the key mediator in all of this agreement, as well as a Saudi vessel. At the same time, with the president making the strike now in Ankara, Turkey, he's really proving potentially the United States point of view to the alliance that more is going to be needed to secure the Strait of Hormuz. And already we heard from the host country, Turkey's President Erdogan, saying that they're willing to go help the United States in terms of trying to clear out the Strait of Hormuz. Remember, when it comes to the energy price shock, which we saw gas futures in Europe spike yesterday, oil, of course, obviously jumping today, this is a bigger problem for Europe, given how vulnerable they are to energy price spikes. And at the same time, this administration does not think Europe has been helpful at all when it's come to the conflict.
Annmarie, appreciate the time. We'll catch up with AMH throughout this morning. The latest out of Ankara at the NATO summit, the latest in the crude market. Brent pushing 80. 79 right now. WTI around 75. Equity futures down about 1% on the S&P. On the Nasdaq, we're down by about 1.5. Joining us to discuss, I'm pleased to say that Ed Yardeni of Yardeni Research joins us now for more. Ed, welcome back to the programme, my friend. So I've been conditioned to ignore this situation. I wake up this morning, I want to ignore the situation. Can I ignore the latest situation in the Middle East?
No, absolutely not. I mean, this is a geopolitical crisis that just won't go away, won't end. The ceasefire, according to the president, is over, and he's clearly in a position to know and in a position to end it. So we're back to square one in some ways, back to where we were in March. I think both sides are testing one another. I think the president is demonstrating to the Iranians that while they may have obviously a significant impact on flows through the Strait, he can shut off their oil to the rest of the world. The unsettling development here, I think, is it may very well be that Iran is basically out of control, that the Revolutionary Guard is not going along with whoever is, quote unquote, on the moderate side, moderate being that they'd like the ceasefire to continue and they'd like to come up with some sort of agreement. But the president made it pretty clear that it's very frustrating, if not impossible, to negotiate with the other side. And so clearly we can't ignore this.
At this point, Ed, it is sort of surprising, as John was mentioning, that oil prices aren't even higher if the truce really is over. Though the pace of increase is pretty notable. The 2-day increase for both Brent and WTI is the most since at least April. And you see just sort of this surge upward. Is there a trigger point, either in the pace of increase or the level, that could make you rethink even the broadening out trade in U.S. equities?
Lisa, the honest answer is I don't know. Nobody knows for sure. So we are all watching the price action in the marketplace, particularly in the oil market. And I think what we're seeing is we're being reminded constantly here that there was a bear market in oil before the war started at the end of February. The bear market actually started when Russia invaded Ukraine. We had a big spike there, and ever since then we've been on a significant downtrend until this war started. So that kind of, and it certainly, everybody was surprised by how quickly the price of oil came down. And I think that just reflects that over in China, they really adopted electric vehicles. And on top of that, their economy is really very weak. And on top of all that, the United States has looked the other way as the Russians have been selling more oil to China and India and other countries. And meanwhile, we've been exporting a lot of oil to Japan and South Korea. So put it all together, and the underlying fundamentals for oil are actually bearish, but they're certainly not bearish in the short term here with the end of the ceasefire.
The volatility that we're seeing, Ed, though, just highlights how much inflationary pressures are coming from myriad places and seem to be persistent, even when you want to say, look, there's potentially a glut because of all of these release valves that you talked about. At what point do you think that this market is underpricing the risk of inflation running a bit hotter, putting pressure, yes, on the Fed, but potentially pressuring certain profit margins for companies that are facing a pretty wearied consumer?
Well, before the June meeting of the FOMC, we thought that the Fed was going to pivot fairly significantly from an easing stance back in April to a tightening stance in June, and that's exactly what happened. The big surprise to me was that Kevin Warsh turned out to be among the hawks because he had, when he interviewed for the job, he certainly sounded dovish. Now the Fed seems to be pretty much all aligned with the idea that price stability is much more important than the labor market. Labor market seems to be stable, but all bets could be off here depending on what happens with the Middle East. The consumer's been doing just great, but if we get another spike in gasoline prices, there may be some kind of geopolitical fatigue. And meanwhile, the market has run into AI fatigue. And as I saw in your brief cuts for all the strategists that you had interviewed recently, everybody was talking about rotation. I was talking about rotation out of the AI trade into companies that we know something about, and we know their future more than we do the AI companies. And that was the Dow Jones, that was the Russell 2000. But now we're all back to, as I said, square one in some ways with regards to the Middle East, and that's become the main focus. And you're right, the inflation concerns are back in play, and as a result of that, the Fed is back in play. Not only is the Fed pivoted to tightening, but they may actually have to tighten.
This is the three-punch combination right now to sentiment, Ed. It's not just the situation in energy, to your point.
Correct.
It's how you fold that into the outlook for interest rates. And the third point is this rotation, quite vicious rotation away from the high flyers in this equity market right now. Lisa Shallard of Morgan Stanley was pretty scathing in the last 24 hours. She said, while many investors are waiting for AI CapEx to actually slow before reducing semiconductor exposure, given what is implied about the sustainability of future growth, we're taking profits now. Ed, you were there too. And I just want an updated thought from you about where that chip trade stands now, given the 16% move we've had just in a few weeks.
Yeah, well, clearly we did have a tremendous rally in the semiconductors, and that, of course, led the way up for the stock market. But the fact of the matter is, it's not a FOMO melt-up. It's been a FEMO melt-up. FOMO means fear of missing out, which typically leads to very elevated valuation multiples, which basically is a valuation-led melt-up. This has been an earnings-led melt-up, and I'd rather have an earnings-led melt-up. I think there's less downside than there is in a FOMO melt-up, and I think it presents more of a opportunity in the market, because the fact of the matter is earnings have really justified the rally in semiconductors, and it's not just expectations, but its expectation is based on actual reality. So I would view this sell-off more as an opportunity than a reason to panic. But right now, we're seeing not so much panic, just massive profit taking because there have been massive profits.
So, Ed, you went there. When would you start buying these chips, these chip names that have been beaten up in just a few weeks?
Well, I think we're getting pretty close because these things move. They don't kind of do things in a leisure fashion. They go up very quickly. They go down very quickly. And so I think there's an opportunity starting right now, but I say that with some hesitation, given that I don't really know, nobody really knows how this latest end of the ceasefire plays out. And so the war is not over is the bottom line here, and the stock market is working on discounting that idea.
The energy market as well. Ed, thank you, sir. Ed Yardeni there of Yardeni Research. The stock market down by, let's call it 1% on the S&P, negative 1.5 on the Nasdaq. Let's get you up to speed. Tons of news this morning. With your latest in the Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. In South Korea, the Kospi down more than 5% in the session, falling into a technical bear market. The index has dropped more than 20% since last month's highs as the AI rotation trade accelerates. The Kospi went from peak to the bear market in just 12 sessions. Demand for Amazon's latest $25 billion bond sale reaching $62 billion. That's about half the orders it attracted for an offering back in March, a potential signal of investor fatigue around AI-linked debt. And in sports, Switzerland advancing to the World Cup quarterfinals after beating Colombia 4-3 in a shootout. And Argentina making a late comeback to beat Egypt 3-2. The two will meet on Saturday in Kansas City, Missouri. Argentina looking to win back-to-back World Cup titles. That's your Bloomberg Brief. John.
Vonnie, thank you. That is the best 30 minutes of football I've seen in the last 20 years.
Salah versus Messi, and suddenly the Argentinian comeback.
Just wild.
Unbelievable.
Did you watch it yesterday?
3 goals in what? How many minutes?
20 minutes or something.
20 minutes. It was unbelievable.
Phenomenal. Goosebumps.
Yeah, I mean,
watching that.
That was going down in the classic pantheon of World Cup games.
Without a doubt. And I'm excited to say there's more to come in the next 2 weeks. Equity futures right now pulling back. Energy pushing higher. Up next on the program, the Iran ceasefire collapses.
To me, I think it's over. I don't want to deal with them anymore, with this scum. As far as I'm concerned, it's over.
Up next, we'll catch up with the former Deputy National Security Advisor, Victoria Coates. Live from New York City this morning. Good morning. So this is what we're waking up to this morning. We're down on the S&P, on the Nasdaq, on the Russell. I should caution up front, this is not just about Iran, it's also a pretty vicious tech rotation that we can cover throughout this morning. The Nasdaq is down by 1.4%, but the Iran effect is clear. In the bond market, yields are higher, bleeding higher across the curve, and bleeding higher worldwide. 2 stateside up 3, over in Europe up double digits at the front end of the curve as we start to recalibrate bets around tightening monetary policy from here, given this move that we're seeing in crude, Brent and WTI. Brent and WTI pushing higher by 5 to 6 percentage points throughout this morning. Brent at 78, WTI at 74. Under surveillance this morning, the Iran ceasefire collapses.
To me, I think it's over. I don't want to deal with them anymore, with this scum. As far as I'm concerned, it's over. I'll speak to our negotiators. They want to negotiate. They're good people. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. As far as I'm concerned, it's over.
So here's the latest this morning. The president saying the tentative truce is over following a fresh round of strikes between the US and Iran as the renewed hostilities send crude higher. Joining us now to discuss, the former Deputy National Security Advisor, Victoria Coates. Victoria, great to get you back on the program in a moment like this one. What's your initial reaction to the developments this morning?
Well, good morning, Jonathan. Yes, I think this is going to be a really important moment, and the ball is in the Iranians' court. They're the ones who decided yesterday. They're supposed to be on some sort of a break for the funeral of the supreme leader, but instead they started shelling ships that were in Omani territorial waters. They weren't even close to Iran. They were going through the Strait on the western side, close to Oman, and got shelled. As we were just reporting, it sounds like one ship from Saudi Arabia was hit. And so all this is going to do is isolate Iran further. The president struck them very hard last night. We have reports of some 80 strikes being taken, which is just going to damage their economy further, weaken them further. But if they want to keep this up, we are, as the United States, perfectly prepared to continue these strikes against their critical infrastructure. It's just going to make it all the harder to rebuild Iran afterwards. But, this is their decision.
Victoria, we're all trying to work out how to interpret the comments from the president. It's always difficult, as you know. You've worked alongside him in his first term. Do you consider this the end of negotiations or just the messy part of negotiations?
No, I mean, I think you can take him very much at his word that he has given diplomacy every chance. He's put his top people on it, invested a lot of his own personal time, and wanted to get to a diplomatic resolution. As he said repeatedly, you're dealing with 90 million people here. Iran is a large country. He doesn't want to do damage to the people of Iran. He wants the regime to not get a nuclear weapon. But if they won't do that in a reasonable way, as has been offered to them, he's also demonstrated that he is willing to use the overwhelming might of the United States military to get to the outcome he wants.
Meanwhile, we also saw that the U.S. barred all additional sales of Iranian oil starting after yesterday, and that was part of the key economic tenet of this MOU, this Memorandum of Understanding. What's the path of travel to salvage anything in this ceasefire going forward? Or do you see this ultimately as simply just being an escalatory move that continues indefinitely?
No, the revocation of the waiver, Lisa, is a major step because Iran's economy is already on, at best, life support. I think World Bank projects them to contract by some 6% this year. That's not growth, that's contraction. So they're already looking at a very, very grim picture, and selling 100 million barrels a day to China was kind of their only last source of income, and now that's going to be cut off. And China is buying more and more from Russia. I don't think they want to be liable for United States sanctions. And heck, we can sell them more oil if they need it, on licit market prices. I'm fine with that. But that's going to be one more piece in the Iranians' really very desperate economic picture, that they're not going to be able to access any currency. They're going to be doing very, very little trade. Again, this is their choice. The administration had offered this as a demonstration of good faith to try to get to the nuclear deal that we want. They've forfeited that. So now there's not going to be any additional trade.
How high is the bar to send troops into the region? We had talked about that a couple of months ago. Then that seemed to be off the table. Is it back on?
I don't think it's necessary in this case. I mean, I think that we've already done a lot of the major damage that needed to be done to Iran, economically and then physically. And so it seems to me that we don't need a larger troop presence. We do have a number of folks in the region right now to support Operation Epic Fury, but it seems to me unlikely that we're going to see a major escalation in terms of ground troops.
Victoria, always good to see you. No doubt we'll be talking again soon. Victoria Coates there on the latest development in the Middle East as the president says the ceasefire with Iran is over. Crude is higher by 6%. The good news, and we've repeated this, we were at triple digits. We were north of 100 and now we're back down to the 70s. At one point, we were threatening to break into the 60s. The tough part, I think, for investors, they've been conditioned to ignore this. Because if you were too bearish for too long, you missed out on a 90% move higher in chip stocks in the second quarter. The problem they got this morning is chip stocks have started to cut the other way.
Well, and also people have underestimated how much supply has come online from other places to fill the gap, not to mention the fact that China has really restricted its use of oil. So all of these aspects coming together to say oil trading seems to be a losing proposition. That said, are we going to see a sort of slow grind up as this does continue? And that is the risk, and Yardeni really was sounding that note earlier.
It's difficult to unpack the equity move this morning because it's so much more than just about Iran, with equity futures down across the board and the Nasdaq down by 1.5%. Up next, we'll catch up with Tom Forte of Maxim Group as Amazon's latest debt sale gets a very cold reception. Check out the scores this morning. We're down by 0.9 on the S&P. We're down by 1.3 on the Nasdaq 100. Worth pointing out, still around 1% from all-time highs as of the close yesterday on the S&P 500, about 1.3% away. Within this index, though, vicious rotation away from chips. The chip sector, the semis, the Philadelphia Semiconductor Index down some 15 to 16% from the highs of June. Worth also pointing out that we were higher by almost 19% through Q2, so we just had a record quarter. That move away upsetting the tech trade just a little bit. And you can see it this morning with the Nasdaq down another 1.3%. There's another wrinkle, though, today. The ceasefire, we're told, with Iran is over and crude is rallying. Check out Brent, check out WTI. Brent pushing 80, up to 78, up by more than 5% on the session. Likewise on WTI. What's intriguing, though, is how this story is playing out in the bond market. Let's just bring up the front end of the yield curve in the US, Germany, and the UK. That's three different central banks with two very different ways of looking at this moment. Twos in America up only 3 basis points, up 10 in Germany, up 11 to 12 basis points in the UK. The ECB and the Bank of England seen as more sensitive to this energy shock if we get a repeat than, say, the US.
We've heard commentary recently as Monday, edifying that belief that you can see in markets. Isabel Schnabel, an ECB board member, came out on Monday and said that the Eurozone's economy is not back to the state that it was before the Iranian war. There still is a need potentially to tighten policy as a result of inflationary inputs from this oil price increase. You're not hearing the same kind of definitive commentary out of the Federal Reserve. In fact, you're not hearing any definitive commentary out of the Federal Reserve. Still, it is data dependency and a question of what the drivers are in a less oil-sensitive economy, which is the United States.
Two different reaction functions. One is clear, validated and reinforced by the move we've seen from the ECB. The other one right now is a bit murky, going into testimony from Kevin Walsh next week.
It is purposely murky because this is a no forward guidance Federal Reserve. That said, the commentary that we have heard from Fed officials does represent a concern about inflation having run too high for too long, more than 5 years. It doesn't necessarily suggest action, though, not the same way that ECB officials
You
are.
can make the argument, I think, this morning that in the last 24 hours, the debt offering from Amazon has had a bigger effect on the US bond market than this energy move this morning on Brent and WTI. We'll come back to that story in just a moment. As we count you down to the cash open, 3 hours away, a lot can change. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. The memory chip trade is back under pressure this morning as investors pull away from risk assets amid the conflict with Iran. And as of yesterday, these names, Micron, Western Digital, and SanDisk, have entered bear market territory. And unlike other pullbacks that investors have quickly bought, this one has stuck. So that means that SK Hynix's listing on Friday is gearing up to be more of a test than a celebration of the AI trade. Meanwhile, it's no surprise that as oil surges, we are seeing the energy stocks, some of the lonely winners in the market, with names like Exxon and Chevron up more than 2% as President Trump says the ceasefire with Iran is now over. So investors are once again pricing in the risk that any disruption to supply will keep oil prices elevated. And we end on another rare winner in the market, and that is Alibaba. Shares are up nearly 10% in the pre-market as investors like what they hear from a pre-earnings update from the company, suggesting profitability in its e-commerce business is holding up better than expected, and that AI demand is continuing to drive strong cloud growth. It's also catching a lift from investors rotating away in Asia from the high flyers, the Samsungs, the SK Hynixes of the world, and into Chinese tech as a cheaper way to play the AI boom. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, the president saying the ceasefire with Iran is over.
To me, I think it's over. I don't want to deal with them and with this scum. It's just a waste of time dealing with them. They're liars. As far as I'm concerned, it's over.
The comments following a new wave of US strikes against Iran and the revoking of a waiver allowing the country to sell its crude. Crude this morning at 5%. Elsewhere, South Korea's Kospi index rocked by major volatility as the AI sell-off deepens. The Kospi entering a bear market down 20% from record highs reached only last month. Whipsawed from peak to trough in just 12 sessions. And finally, Amazon's latest debt offering, drawing softer than expected demand, seeing about $41 billion in final orders, well below the year's average for high-grade bonds. The tech giant now reportedly saying it won't issue any more debt this year.
Yeah, all it needed was more than $100 billion of debt. Now it's good. Look, just to put this into perspective, there's been about $335 billion of AI-linked corporate debt that's been issued so far this year. Amazon accounts for almost 1/3 of that. So it gives you a sense of how much they have been hoovering up cash at this moment where borrowing conditions have been good. What are they using it for? Are people fatiguing? Sure. You could see credit spreads widening. You could see that the oversubscription, which you always raise questions about, wasn't necessarily there. Nonetheless, it does also highlight that maybe we're reaching the end. Nonetheless, that open tap market seems to be closing just a little bit when it comes to debt investors' appetites.
They offered concessions and demand still wasn't great. And you saw the weakness in other debt from other tech companies in the secondary market. What does it speak to? Are we testing the limits of demand for this kind of debt? I would say we're testing the limit of demand for this kind of debt at this yield level. And that's what that market is telling you, that if you want to make these kind of issues going forward from here, you're going to pay for it.
There's going to be a bit more speculation embedded in some of the understanding of what these issuances are, considering how much money is being raised and what they're buying into, which is indefinite. I mean, it's always indefinite, but it's even more indefinite. Adding to this, there's supply coming from other places, and you hinted at this. How much was the Amazon debt sale crowding out treasuries? Well, today, how much will treasury issuance crowd out some of that corporate bond issuance, and how much will be left over? There's going to be $39 billion of 10-year notes sold today, $22 billion of 30 years. Tomorrow, how much appetite's left?
Torsten Slok, Apollo, this is what he said. The hyperscalers are issuing so much IG corporate debt that this is crowding out demand for US treasuries. We've heard it from Apollo. We've heard it from BlackRock too, by the way. We've heard it from a number of investors that the issuance that we're seeing from the hyperscalers will be at the expense of treasuries. And this is the issue that you've got in the treasury market. You've ignored the supply story for a long time because you weren't seeing much competition from elsewhere, not just on the debt side, but also on the equity side. By the way, things have changed on both the debt side. They have changed markedly on the equity side as well. That's additional supply cross-asset.
Which is why even when you say, OK, the Fed could potentially tighten rates, do you like the long end of the yield curve? You ask one bond investor after another, maybe, we're not sure, because the dynamics get pretty tricky when you look at all the debt being issued.
Let's talk about Amazon. Tom Forte of Maxim Group maintaining a buy rating on the stock. He has a 315 price target. He writes the following: Amazon is best positioned among the mega cap stocks to capitalize on AI-related opportunities. Tom joins us now for more. Tom, welcome. You cover the stock, but you follow the bond market. What did you make of that auction in the last 24 hours?
Yeah, so I think about Jonathan, good morning. So I think about the 1.6 times demand for the deal offering, down for 4 on average earlier this year. And I do think it's consistent with my view that the AI trade has gone from uber bullish to a bullish bearish combination with still a bullish bias. I think you're seeing some concerns, not just from investors, but for consumers on the AI build out. And I think it suggests perhaps that in the future, for the hyperscalers, they may have to pay higher interest rates if they continue to fund their AI investments with debt.
Tom, do you think that Amazon is alone in saying that they don't need to raise more money this year in the debt markets? Or do you think that they just satiated their demand with more than $100 billion front-loaded in the year, and the others are going to have to face a much more tepid market?
I do think Amazon was early in raising its debt capacity or the need for capital. So in that regard, I do think it perhaps may be alone, Lisa, as far as requiring debt later this year. The company does generate significant free cash flow. And I think that if you looked at it, they had $123 billion in cash and short-term investments and $66 billion in debt as of the March quarter before this offering. The good news is, though, Amazon has shown an ability to flex its investment spending, flex it up, flex it down. So I think that the good news here is they're seeing the returns on investment they're hoping to see on their AI investments, which is why they're moving forward with all that debt issuance. But if they weren't to see it, then I do think they could scale back that investment spend. $200 billion this year becomes materially lower next year. So I am confident in Amazon's ability to manage its capital needs well.
I want to build on that, Tom. The idea that if tepid demand in the debt market potentially could affect capital spending plans by the likes of Amazon, do you see that the additional hesitance on the part of bond investors could constrain hyperscalers' ability to pay an indefinite amount for semiconductors, say? Does this edify what we're seeing in the semiconductor space with the sell-off?
I guess the way that I look at it, Lisa, is the higher memory costs making it more expensive for the hyperscalers' CapEx efforts. You see in the case of Amazon, though, they essentially maintained that $200 billion outlook despite the higher memory costs. So now we may be looking at conditions where you have higher memory costs and higher interest costs, which just makes it ultimately more expensive for the hyperscalers, assuming that they continue like the demand and continue to keep that investment ramp going. So at this point in time, Lisa, I'm not overly concerned that you'll see a softness in chip sales as a result of potentially higher interest rates and less investor demand for these bonds.
So, Tom, ultimately for these companies, there are two different ways of looking at things. Either you can pull back on spending or find new things to buy. You cover Apple too. They're looking to find new things to buy within China. What do you make of the latest pivot potentially on the horizon?
So I think for Apple, it's been interesting to see how well they've navigated the slow rollout of AI for Apple. And I'll be looking forward to see how John Ternus handles that when he comes in September. They do seem to have done well, Jonathan, in their ability to capitalize on Google's Gemini to support Siri. As far as advancements in China for Apple, something I guess I'm continuing to monitor.
Are they going to look at buying Chinese hardware, Tom, to sell their product in China? Is that going to be the story for them to try and manage the margins a bit?
I think it may be a situation where I'm curious to see if they work with Alibaba, who they work with in China, to advance their AI-related efforts in China. They did talk at their developers conference about challenges, regulatory challenges in both Europe and China when it comes to rolling out AI there. As far as buying incremental Chinese hardware, I guess it's something that I'm going to continue to monitor.
How much, Tom, do you view Apple's announcement that it was going to look to Broadcom for more U.S.-made chips and potentially its own chips as a way of placating some of the concern coming from either the administration or investors about its supply chain?
So, Lisa, when I think about March earnings and when I look forward to June earnings, there was a lot of conversation about tariff refunds or tariff rebates. And for Apple, they enthusiastically indicated that they would take all the tariff refunds and reinvest them in the U.S. So I am not surprised by that commentary from Apple about ramping its U.S. investment spending and potentially doing some of that with refunds on tariffs.
Hey, Tom, it's good to see you. Thank you, buddy. Tom Forte there.
Thank you.
Of Maxim Group on both Amazon and on Apple. Apple, of course, has not spent anything like what we're seeing coming from other companies, including Amazon. How sensitive are they to the pushback that you're receiving from the debt market? How sensitive is a Meta to the pushback you've received from the equity market? That's my question at the moment.
Last year, it didn't seem that sensitive because it was an existential crisis to try to amass as much capacity as possible and as much in terms of resources as possible. Now you see a sort of rationalization of the spending around artificial intelligence. You see increasingly cutbacks around the edges as people offset the spending. You have people restricted in their token use. Token maxing is now, is something very different. Gives it a different feel, and it seems like people are looking at the practicality of this, not just sort of the hopes and dreams.
Things have shifted. That's upset the chips trade, that's for sure. It's why we're down by about 16% in just a couple of weeks. Let's give an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. NATO considering skipping next year's annual summit. Sources telling us here at Bloomberg the meeting scheduled for Albania could be postponed to avoid creating another platform for President Donald Trump to disparage allies. SpaceX AI and Cursor are planning to launch their first jointly developed AI model as soon as today. The information reporting the model is expected to process information quickly enough to compete with products from Anthropic and OpenAI. Now an update on the compromised New York City housing project under construction in Midtown Manhattan. New York City's buildings commissioner telling the New York Times, quote, "The building is stable and he feels confident in the emergency plan in place." That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, betting on AI.
We are bound overall by AI.
The demand for AI is only going to go up.
This market is just beholden by tech and AI.
What does it mean for demand for the US dollar? George Saravelos of Deutsche Bank joins us next. Live from New York City, you're watching Bloomberg TV. Equity softer this Wednesday morning. Good morning to you all. We're down by 0.8 on the S&P. On the Nasdaq, we're down by 1.13. We're bouncing off the lows just a little bit, still down about 1 percentage point on the Russell 2000. The move in crude setting the tone for the market this morning, not just in the US, but worldwide. Up by about 5% on Brent to 78. WTI to around 74. That's having a different impact across fixed income. If you look at the front end of the yield curve, and we've done this all morning, just comparing the US to the UK and Germany right now, the bigger move is in Europe. There's just a take, really validated and reinforced by recent action from central banks like the ECB, that those central banks in the UK, in Europe, will be far more sensitive to this move in crude than we will be at the Federal Reserve. So we reset on Tuesday to 420. In the US, in Germany, it's a push higher by 9 basis points. In the UK, it's a push higher by close to 11.
And it's edified, frankly, by commentary coming out of Europe with a lot of central bankers saying, look, this is a clear problem, and the more the oil prices remain elevated, the more we're going to be forced to respond. Key question is we don't have a sense of what the reaction function is for the Federal Reserve. So later this month, we're going to get a better sense of exactly how willing they are to actually tighten rather than just simply job on the market, which is what they've been doing for a while.
Let's talk about what it means for the FX market as well. Under surveillance this morning, betting on AI.
We are bound overall by AI.
AI in the markets, it is the dominant feature.
The demand for AI is only going to go up.
This investment cycle isn't slowing. This market is just beholden by tech and AI.
So here's the latest this morning. Massive spending on the AI build-out, pulling international investors into the American market. SK Hynix preparing to debut on the Nasdaq this coming Friday. George Saravelos of Deutsche Bank writing the dollar will be the predominant beneficiary of future AI income streams. George joins us now for more. George, welcome. This is kind of off the beaten trail, so to speak. A lot of people aren't focused on this right now. George, are you suggesting that this US dollar will become more leveraged to this AI story?
I think that's absolutely what's been going on, John. I mean, if you look at the last 12 months and you look at the funding of the U.S. current account deficit, which is one of the accepted weaknesses of the U.S., it's now that funding has massively shifted to what's being funded via equity inflows. So it used to be the Treasury market that was the destination of dollar-based investors. And now it's all going into equities, of course, all powered by the AI rally. And that in and of itself is creating very different vulnerabilities for the US, depending, of course, on your view on where AI is going.
George, does it make it more volatile? Is that the story? How does the character of the currency change with that in mind?
I think if you look at the last 10 or 15 years, the dollar has had this safe haven property. So during periods of risk aversion, it's been rallying. Now, of course, these sources of risk aversion have usually come from the rest of the world, whether it was the Russia invasion, the COVID crisis. But I do think if you are in an environment where the source of risk aversion is a derating for whatever reason of tech and AI valuations, you could very well see an environment where the dollar weakens. So in that sense, the correlations would flip. Actually, if you go back to the 2000s, when the dot-com bubble unwound, you did see a period where equities were going down and the dollar was weakening at the same time. Now, I'm not suggesting that would necessarily take place this time around, but it does change the source of vulnerability for the dollar compared to what it was.
If there was a derating of AI-related names across the world, but particularly in the United States, what would the dollar derate against? What would it weaken versus, considering the fact that a lot of the Asian currencies are just as tied to the AI trade?
Well, it's a very interesting question because if you look at Korea, for example, which has been one of the huge beneficiaries, the currency is actually weakened at the same time because investors have been forced to sell some of those underlying equity holdings to reduce allocations. So it's not intuitive what the reaction would be for some of those Asia currencies. But what I would say, Liza, is for things such as the euro, which in general have not been beneficiary of those inflows, we would expect the euro to strengthen against the dollar in the event we do see an AI derating. And I think it's precisely for that reason that I would identify the risks around the dollar as being quite fairly balanced, given these AI risks as they relate to the financing of the deficit.
We're also dealing with an oil-related risk, and we've been talking about how the reaction function is very different in Europe than, say, the United States. A greater likelihood of tightening by the ECB, by the Bank of England, in response to higher oil prices. Does that make the euro more valuable or less valuable based on the potential hit to growth for the future?
So I think to start with, again, you look at the market reaction this morning and you see a much larger reaction in the European front end compared to the US. And I think that's valid. If you look at Sintra last week, the major ECB conference that took place in Portugal, again, the entire framing of the reaction function of these central banks is around scenarios of the energy price. So it does make sense the market is a lot more sensitive to that. I think the currency transmission, it runs through the real rate channel. So if the only reason these central banks are hiking is because inflation is moving higher, not necessarily as supportive for the currency. We saw that in 2022, of course, where despite the hikes, the euro weakened. But I would say a big difference this time is that growth in Europe is a lot more resilient. If you strip out all the noise around the Irish GDP numbers, which tend to move up and down by 10 to 20%, Europe has been pretty resilient, which is something Lagarde had spoken to. And if that allows growth expectations to hold in, more recently, actually, just a few days ago, we had some major reform announcements out of Germany. So we would expect some sentiment uplift there. I think the negative currency impact because of the growth downgrade would certainly be much less.
George, how live do you think these July meetings are? How live are they? In a few weeks' time, the ECB meets, the Federal Reserve does too. Are they live meetings?
So in Europe, I would say probably not, but I need to be careful with what I'm saying because it all also depends on the oil price. We probably need to see a much, much larger reversal in the oil price for the European meetings of central banks to be live. I think the Fed is a more open question. As you alluded to, the reaction function is still quite uncertain. When I was last on the show, I did say that Walsh would have quite a tough job of navigating that first meeting. And he did do a very good job in the sense of reinforcing Fed credibility, but without giving us a more precise understanding of the reaction function. So I'd say the Fed is a bigger question mark, and it would also be highly dependent on the CPI number we're getting next week.
I don't want to get you in trouble with Mark Wall, George, but let's just play this out. Let's just say crude is where it's at right now and these tensions haven't been resolved. Is that ECB meeting a live one?
So we do have one more hike in September, and I think given that the level of oil prices as they currently are, that's probably quite fair. It's interesting, Lagarde sounded a bit more dovish last week in Sintra, but then again, the oil price was a bit lower there. I think as things stand, you'd probably need the oil price, and when I mention oil price, I'm talking about the entirety of the curve, 2 to 3 years out, being closer to $70 for the ECB rate hike of September to be less likely.
OK, George, appreciate it. Thank you, buddy. George Saravelos there of Deutsche Bank, who, of course, works alongside Mark Wall, who makes their interest rate decision over the ECB. So they're looking for September. Do you get some pull forward if this problem doesn't get resolved in the next few weeks?
It would seem that it would have to be a pretty significant spike upward in terms of the oil prices, and what that threshold is TBD. I think the more interesting point actually is what the Fed does and then what the reaction is in markets, because you do have people playing around with the idea of rate hikes this year by the Federal Reserve. July doesn't seem to be on the table, though. I mean, it's not the labor market that's overheating based on the report that we got last week. It isn't necessarily massive inflationary pressures that are accelerating beyond oil. So these are the reasons why people are saying, wait for the task forces, wait until after you've really gotten your seat warm, and then maybe you can make a decision.
We're going to have a big family fight in July. The words of Kevin Walsh.
Yeah, sounds like fun.
Right.
I can't wait to get the meeting minutes today. Maybe we get a sense of just how big that family fight's going to be.
How short are those minutes going to be?
Exactly.
Yeah, look out for that. Later on this afternoon, we talked.
We talked. It happened.
Several officials also talked.
They said the.
Coming up next, Dan Greenhaus of Solus, Samantha Dowd of Goldman Sachs, Vishal Khanduja of Morgan Stanley, and a whole lot more as we cover the latest developments out of the Middle East. The second hour of Bloomberg Surveillance up next.
The economy is still strong.
The economy is proving somewhat more resilient than a lot of people expected.
It's really about the inflation data.
We have signs of disinflation in the economy.
We could get a little bit more, I don't know, easing, but hikes coming out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures pulling back 0.9 on the S&P. We're down by 1 full percentage point on the Nasdaq. Yields bleeding higher worldwide. Stateside 2s, 10s and 30s look like this. Yields up across the curve. 2s up by 2 to 3 basis points. 420 this morning. Close to 460 on 10s, through 5% on 30s. Off the back of this move in crude. Crude higher on WTI and Brent, higher by around 5% this morning. 78 on Brent, WTI at 74. The president says the ceasefire is over.
And it has been cracking. I mean, yesterday you got this sense and you got the news that the U.S. was removing some of those waivers that allowed Iran to sell some of its crudes that would prevent them once again starting today. And then today, ceasefire is over after subsequent attacks. I'm looking at the two-day move in Brent crude. It is the biggest two-day move since March 18th of this year. That is when the initial conflict was beginning. We're up more than 8%. It just raises this question, how much further does it have to go to really upset the risk appetite in markets and make people pay attention after trying to ignore the story and hoping it would just go away?
I think that's the story still this morning for many investors, hoping that they can still ignore this story. Can't ignore the front end of the yield curve worldwide right now. On two stateside, not a big move, up by a couple of basis points. In the UK and Germany, up by around 10. There is a question, I think an important question, over the next few weeks. How live are these central bank meetings at the Federal Reserve and the ECB in the next 2 weeks?
Investors seem to be suggesting it potentially is more live over in Europe simply because the commentary has pointed them in that direction. I keep going back to what Isabel Schnabel in commentary on Monday said. Does the decline in oil prices mean that we are back to the pre-war situation? I don't think so. The peace deal is fragile. Gas prices still around 40% higher than before the war. They might have to still tighten. You have this kind of rhetoric. You have a big blank question mark coming from the Federal Reserve at the same time that the U.S. economy is a whole lot stronger. A big question mark. At the same time, we don't know the reaction function from the Fed, and there's going to be a family fight.
I'm not sure if it's a moment to get super bearish, but you can just see how things are building. Got the move in crude, a bounce back again. Still in the 70s, that's okay. The 80s, it gets worse. The 90s, it gets even worse. I think that's obvious. You start to price in the prospect of firmer monetary policy, hikes maybe from the Fed and elsewhere, at a time when we're seeing a pretty vicious rotation develop in tech as well.
I keep going back to what analysts said earlier this year, that the worst case scenario for central banks is not oil prices going to $150 a barrel. It's potentially $70, $80, $90 a barrel, where you won't necessarily get demand destruction, but you will get higher input prices that filter through the economy, which to some degree is what you've seen so far. If this persists, even if it isn't a massive increase, does that potentially increase the chance of rate hikes without necessarily surging to astronomical levels?
Nasdaq futures this morning down by 1.3. The S&P through much of this morning down about 1 percentage point. Coming up this hour, we'll catch up with Dan Greenhaus of Solus, with investors rotating out of chip stocks. Samantha Dada, Goldman Sachs, as fresh strikes against Iran has crude spiking. And Vishal Khanduja of Morgan Stanley on the wave of big tech debt flooding the US market. We begin this hour with stocks heading lower as AI spending concerns are sparking a rotation away from the chip sector. Dan Greenhaus of Solus writing the following: the idea of broadening out has merit. If I look at the S&P but ignore tech and comm services, we're regularly hitting new highs for the first time since February. Dan joins us now for more. Dan, good morning. Good to see you.
Good to see you, sir.
The
Thank you.
word we often hear is healthy. It's a healthy rotation. What would make it unhealthy?
Wow. I'm not sure anyone's ever asked me that before. Listen, I don't know. The argument I've made in the past is I don't know that I need rotation for rotation's sake. There's always been this issue several quarters ago. Can the market survive if the Mag 7 don't go up? And my position at the time was unequivocally the answer is no. Mathematically, that would be really difficult for the rest of the market to compensate for the Mag 7, given how large they are mathematically in the index. And yet, that's more or less exactly what's happened.
The new question is, can the market survive in the chip sector?
Yeah.
Starts to sink.
Well, I think the answer, that answer I would have said and will say is yes. Now, that said, the best question, since we keep inceptioning ourselves higher here, the best question is, can the market survive if the AI trade in general falters? And the answer to that, I would have said, will say, and will always argue, is no. That is driving, as we've talked about, and everyone does, materials, utilities, industrials, et cetera, et cetera. If that falters, I think we've got a real problem on our hands. Until then, It's just, as someone said, the water sloshing around in the pool without any coming over the edge.
Is there a sign that perhaps it is not necessarily coming to an end, but fading slightly in the imagination, certainly of debt investors? Does Amazon's debt sale yesterday and the tepid demand relative to what it has been signal some warning signs that potentially this could be waning?
Yeah, listen, I think it's certainly not as good if the issue was 7 times, 10 times oversubscribed, sure. But listen, the IG market is now, the listed IG market is now 10 trillion in size. Tech is still a relatively small portion of it. There's ample room for these companies to increase issuance. All of these companies, as we've discussed ad nauseum, have very low leverage ratios, less than a turn, in some cases less than half a turn, except for Oracle, which has a couple of turns of leverage. So I don't think that's necessarily an impediment right now. But that said, when you have these small indications here and there, the Meta announcement about selling compute capacity, they start to accumulate at some point. The issue as an investor that you have is, when does it end? When is this trade over? That's obviously nearly impossible to ascertain in advance. It's probably more likely you're going to get it right 3 months later. But I don't think enough has happened as of yet for the average investor. And as a reminder, Solus, we don't invest in large cap tech. It's not what we do. But I don't think the average investor can look at what's happened thus far, should look at what's happened thus far, and conclude this is coming to an end.
Does the softening in demand for Amazon signal something about the AI trade, or does it signal something about the desire for debt at a time when everyone is flooding the market, not just tech companies, but also governments?
No, I don't think that's an issue. I don't think that's an issue. The global bond markets, global treasuries, et cetera, I see no particular signs of stress. IG spreads are 75. High yield spreads are, forget inside 300, inside of 275. I don't see anything that says there's any issues really anywhere other than the typical idiosyncratic issues that permeate the lower end of the high yield market. I don't think that's an issue. I think just maybe there was something with the issue that didn't generate an enormous amount of interest. But I wouldn't, again, read too much into it. These things happen from time to time, that it's not super oversubscribed. But again, let's forget, getting back to the rotation comment to start, when we X out, forget the Mag 7, when you X out all of tech, when you X out all of comm services, you're making new highs on a regular basis now for that, what we'll call index, for the first time since the winter. So there's clearly a positive momentum in both debt and credit markets right now, and I wouldn't read too much in any one indicator here or there.
Before we switch back to equity, let's just stay on debt. We have seen a bit of softening in the secondaries. We've seen that. We've seen a lukewarm response to SpaceX. That wasn't well oversubscribed. In fact, that's traded pretty poorly subsequently as well. Those issues are kind of building up. And if you look at the weakest part of high yield, let's say to the triple Cs, you're starting to see that widen out a little bit. And I just wonder if that starts to migrate up in quality.
I don't think so. Why not? Because ultimately the economy is doing fine enough right now. I think you had a problem a couple of weeks ago where we were talking about the Federal Reserve raising interest rates, and that spooked everybody out a little bit. The 10-year backed up 355, 360. And then the lukewarm jobs report and Kevin Warsh and the Fed commentary put the kibosh on that, as we'll say. And so even though we're still pricing in 1 and change cuts or whatever it is by the end of the year, I don't think that's going to come to pass. So I wouldn't read too much into the triple C market. I mean, for anyone who trades in the triple C market knows this is not a market. It's just a bunch of companies that find themselves in not great straits, if you will. So I don't think there's...
You know why we're tracking this, though? We're getting a ton of issuance on the equity side, a ton of issuance on the debt side.
Well, a ton of issuance nominally, but relative to the size of the market.
Of course. But just trying to know the change in the wins and just picking up on individual markers and how they're accumulating. What are the markers that you would look for that would give you pause, give you concern?
Again, to me, and I'm a broken record on this, when something goes wrong with that AI trade, and by that I mean CapEx slows down, someone somewhere in some corner of this suggests that demand is even equal to supply, let alone completely exceeding it, which is what we hear from everybody. When that happens, I think you're going to have to take a wholesale you're going to have an investment committee meeting and say, is this it? Because again, industrials, materials, utilities, obviously tech and commerce, it's a huge portion of the market. I really should sit down one of these days and do an S&P XAI, which is going to be a fun exercise. I think it is driving the entirety of the market.
And that's the issue, Dan, and that's why we're talking about it, because the market response to additional debt and equity supply could set the tone for future spending.
Yeah, but then I always fall, yes, that's fair, but then I always fall back on arguably my favorite saying in the market, which is bull markets don't die of old age, the Fed kills them. And as long as you have the Fed keeping rates where they are, which depending on who you are, might be too restrictive, might not be restrictive enough, I think a Fed on hold through the end of the year, plus the continuation of those demand trends that we see, keeps this market on an upward bias, to me.
How much do you need to see profit margins start expanding dramatically at non-obviously tech companies to sort of see the productivity, to see some of the gains bearing fruit across the industry and earnings next week?
Well, we've seen index-wide profit margins grow to, let's just call it record highs in the mid-teens, let's say. I have to go back and double-check what it is on a sector basis, because I'm sure someone's watching saying, yeah, but it's all... And historically, admittedly, it has largely, if not entirely, been technology driving broad market and broad economy margin gains. So I have to go back and look sectorally. But presumably, that's going to happen. The consumer's doing fine. I just mentioned off air, I was just down at Epic Universe in Florida. I don't know, no shortage of bags holding Minions toys at Epic Universe by everyone I saw.
World Cup sold out.
World Cup, 4,000, wasn't it the most expensive ticket of all time?
Pretty crazy.
Yeah, and then there's, of course, tickets to concerts. Look at the chart of Live Nation. The consumer's doing fine. The economy's doing fine. I forgot how we got off. I got distracted by Epic Universe.
No worries. I mean, look, we're trying to gauge out, has there been this shift? And at the beginning of this year, especially when the conflict began in the Middle East, people were talking about tech stocks as a haven. Are they still a haven in some capacity, or has the nature of the trade changed?
Well, no, some of them are safe, if you will. But I think it's a good observation to make that over the last 3 months, only one S&P sector has outperformed the S&P 500, and that's technology. Month to date, granted a small sample size, they basically all have. And I'm not going to read too much into 8 days of a month or whatever, I guess we're July 8th. I'm not going to read too much into it, but that is something to observe. And there are any number of sectors that you can look at right now. Look at the hotels, Hilton and Marriott. Look at the refiners. We talk a lot about the banks doing well, but what about the non-traditional banks like State Street, Northern Trust? They're surging. The rails, UMP and CSX. The malls, the short trade of the century. Pull up a chart of SPG. Certain healthcare names, as we've discussed. There's a lot of stuff. It's not doing as well. It's not as large as, and so it doesn't get the attention. But there's a lot of parts of this market that are doing well that tell me that there's more going on here than just the AI trade. Now, that said, again, clearly, this is the dominant theme. It's helping drive the economy, not quite to the degree some people assert, but it's helping drive the economy. It is definitely driving the stock market, but there are other things going on. So I wouldn't, safe haven implies nothing else is going on, and I don't think that's entirely accurate.
Dan Greenhaus, Solus Alternative Asset Management. You want to stick with us?
Sure.
Get this man a coffee, all right? Let's get him to wake up a little bit. Let's get you an update on stories worldwide this morning. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The Trump administration lifting restrictions on OpenAI's newest model, GPT 5.6. Axios reporting the ChatGPT maker will make its most powerful model series available to the public Thursday. Microsoft is replacing OpenAI and Anthropic with its own models in software products such as Excel and Outlook. Sources telling us here at Bloomberg Microsoft's goal is to ultimately eliminate the cost of using Anthropic models. Nvidia stock is the cheapest it's been since before the AI boom kicked off. The stock falling 16% since hitting an all-time high May 14th and losing roughly $1 trillion in market value in less than 2 months. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. More from Vonnie in about 30 minutes' time. Up next, the ceasefire is over.
To me, I think it's over. I don't want to deal with them anymore, this scum. As far as I'm concerned, it's over.
Up next, we'll get the latest from the NATO summit in Ankara, Turkey, with Bloomberg's Annmarie, live from New York City this morning. Good morning. Stocks lower across the board here. We're down on the S&P by 0.9%, on the Nasdaq 100 down by 1.3. Big rotation out of chips. We can talk about that throughout this morning. The new wrinkle for this market developing in the crude market. WTI and Brent this morning pushing higher by around 5 percentage points. We were threatening to break into the 60s on Brent. Now all of a sudden back to 78, up by 5 to 6% this morning. WTI back in the mid-70s at 74. Under surveillance this morning, the ceasefire is over.
To me, I think it's over. I don't want to deal with them anymore. They're scum. As far as I'm concerned, it's over. I'll speak to our negotiators. They want to negotiate. They're good people. As far as I'm concerned, it's just a waste of time dealing with them. They're liars. As far as I'm concerned, it's over.
So here's the latest this morning. Tensions rising between the US and Iran, with President Trump saying the tentative truce is over after launching a new wave of strikes. Annmarie has the latest in Ankara, Turkey at the NATO summit. Annmarie, the president has turned away from being tested repeatedly in the Middle East by the Iranians. What changed overnight?
Well, he decided that it was time to really strike back on the Iranian aggression. This came after Iran struck 3 ships. I think it's key to understand the countries behind these ships. One was a Qatari-led LNG tanker. Of course, they're the main mediator for all of these talks, as well as a Saudi ship. And then on top of that, the president revoked the waivers they gave to the Iranian regime and then started strikes on about 80 targets. And the Iranians have responded, going after U.S. targets in Bahrain and Kuwait. So it looks like the president said that he is not willing to continue these negotiations because he feels that it is a waste of time. They have continued to test him, and clearly this is the biggest blow-up we've seen since the signing of the Memorandum of Understanding, with the president saying that basically, according to him, it is over right now. The Iranians said parts of the Memorandum of Understanding they think are completely dead. At the same time, we should note there has been quite a pattern when it comes to the United States dealing with Iran, fits and starts when it comes to potential skirmishes as well as talks. The president said he would allow his negotiators to continue talking, even though he thought it was a waste of time.
So, Annmarie, that's the question. What are the consequences? What are the consequences to ending the ceasefire? Does it end up in a messy negotiation from here? Does it end up at the end of negotiations and the start of a new operation? Any kind of signal coming out of the government?
Well, at the moment, the signal is that the U.S. will take on these strikes. There haven't been anything new in terms of overnight strikes, but we've had strikes now, and the president's rhetoric, which was incredibly hot, saying the Iranians are, quote, scum, and also saying that the regime is, quote, cuckoo. So obviously the tension is very hot right now and escalated, even if we were to hang on to a very fragile ceasefire. What makes matters worse potentially as well is that the Qataris are obviously incredibly frustrated as well, given the fact that their LNG vessel was one that was targeted, even though they have been trying to play this role of mediator. So things are not good right now on the ground in the Gulf. At the same time, if we see an increase in oil prices, is that going to be enough ahead of the midterm elections for the president to say, I would like to re-engage and try to have these talks again? And also, the regime at this moment will be asking themselves the same question. Is it worth some of these attacks, aggression and defiance in the Strait of Hormuz? Is it worth it to put all of our oil sales at risk?
Annmarie, thank you. AMH in Ankara, Turkey at the NATO summit following the president. What's that saying you love? Fool me once.
Yeah, I'll get it for you. Fool me once, shame on you. Fool me twice, shame on me. And right now, this market's like, we're not going to be fooled for the 8th time. So ultimately, we're not going to trade that much. Nonetheless, you are seeing the biggest hike up in price for a 2-day move going back to March when it comes to Brent crude. So clearly, people are getting a little yippy.
Dan Greenhaus, still with us. Dan, conditioned to ignore it. We want to ignore this. So many investors this morning want to ignore this. Can they ignore this?
I just want to correct the record and say the saying is, fool me once, shame on you. Fool me, you can't get fooled again. That's the famous George Bush quote. Viewers will know what I'm talking about.
Thank you very much for the correction.
Bush was kind of butchering it, right? Yes. We remember it.
Thank you. I appreciate that.
If you're not familiar, I'll send you the video.
Thank you.
We've seen the clip.
Yeah, there's young people watching who don't even know.
Maybe they haven't seen the clip.
And they think that you're actually correcting me, but carry on.
I'm not actually correct. I'm not actually correct.
Okay, all right, all right.
Okay. This is good TV.
On the golf course, right?
What's that?
On the golf course.
Oh, on the golf course. This was right around the time he also said, that doesn't matter. We'll leave this for Politics Nation or whatever the show is called. I'm sorry. So I think the quote I would use, the saying I would use is maybe won't get fooled again. And I say that as someone who early on in this was among the group saying there's a certain level to which inventories cannot fall. There's a certain length of time to which this cannot go, and things are going to get bad. And it got bad preliminarily and then didn't. And I think there was a real underestimating of the amount of alternative sources, the East-West pipeline, Yanbu, et cetera, and the Fujairah pipeline, that ameliorated the worst case outcomes. And I think the reason why oil is up only 5% this morning, granted it's one day, is I think having spoken to any number of investors over the last couple of weeks, and I'm sure you have as well, there's a sense that this whole group was telling me the sky was going to fall, and it didn't. And now I see this headline this morning. I think the argument's going to be the most likely outcome for both of these sides, the U.S. and Iran, is to not have this spiral out of control. They'll find some off-ramp, no matter how embarrassing it might be or difficult it might be. And so, therefore, I'm not going to get too concerned in a larger sense. That's what I guess is going to happen.
Is that potentially the worst-case scenario when it comes to central banks? Because what you get is elevated oil prices without the demand destruction that comes along with it.
Sure, except I don't know that I would call $80 Brent elevated. I mean, it's higher than it was, for sure. But from a central bank standpoint, I'm not sure I'm going to get all that more concerned about my various landscapes than I am right now. I certainly don't think the Federal Reserve is going to look at $80, or I should say $75 TI instead of $70 TI as some threat. They've missed their target for 5 years, as we all know. I don't think that's going to be the difference here. What you have to figure out if you're them right now is first of all, you don't want to tighten monetary policy in response to a spike in oil prices that you think is going to be temporary. And this is, by definition, temporary. Whether it's 1 month or 6 months, who knows? But
unless you're the ECB.
Kind
of do things differently over there.
Hike 100 basis points.
That's fair. But the ECB also has a single mandate. The U.S. has to worry about unemployment, et cetera. But yeah, I think you have to figure out how much of this is tariff, how much of this is demand, how much of this is idiosyncratic issues. Kevin Warsh spoke about focusing in on things like the median CPI, which I think is a perfectly legitimate argument. Thank God someone finally made it. Instead of just arbitrarily picking two items, food and energy, and Xing them out. Why not X out the more volatile ones? So I think they're going to struggle to figure out the various components of what's driving inflation higher. I just don't think the famous last words, but another temporary spike in oil prices is going to be what confuses them at this point.
Have you got the Fed unchanged for the year?
Oh, I think at this point,
best guess.
I know the market's pricing in 1 and change hikes. My best guess is that they don't hike this year. I certainly don't think they're going to cut, but I don't think they're going to hike. I mean, assuming this is temporary, oil is a huge driver, obviously, of headline inflation, but it also filters through to the core. You've had gasoline prices at the pump was $4.50, now $3.80. So that from an inflation expectation standpoint is going to be helpful. And from a headline standpoint, the drop in oil prices, we've probably seen, famous last words again, we've probably seen the peak in inflation for the year, and that's going to give them a little cover as the year progresses to be on hold.
We hope we have. Dan, it's good to see you.
My pleasure, guys.
Now watch this drive. Dan Greenhaus, the Solus Alternative Asset
Okay, you do know it.
Thank you. Coming up, Samantha down at Goldman Sachs as oil surges on President Trump's latest threats to Iran. Plus, Yahara has your morning movers. Memory stocks falling into bear market territory. The Kospi, what a ride. The Kospi down 20% in just a few weeks. Things were quiet to start the week. They've got progressively busier and louder. Equity futures right now in the S&P 500 pulling back by 0.9%, down by 1.4 on the Nasdaq 100. On the Russell, the small caps down by about 1.2%. Into the bond market, yields pushing higher. Worldwide, not just stateside. Stateside yields are higher by just a couple of basis points. Much bigger move abroad. At the front end of the curve, we're seeing 10 basis point moves in places like Germany and the UK. Off the back of this move in crude, the ceasefire is over, we're told. The president's words a little bit earlier on this morning. Brent back to 78, up by 5 to 6%. Bramo WTI in the mid-70s with the Fed meeting just a few weeks away.
Yeah, how much does this have legs? And I think that's what a lot of people are grappling with. A lot of people want the story to go away. People have been hoping that we've just seen the peak in terms of oil prices and inflationary pressure. There is a question. How much does the pullback in demand from China offset this? How much does the trickle of ships still going through the Strait of Hormuz potentially offset this? How much does increased production from places like the United States? Or how much are people sleeping into a potential conflict that threatens oil prices to rise substantially higher and potentially could cause central banks around the world to act?
I think many people wishing they stayed in bed this morning. Brent crude at 78. Let's get you some single names, some morning movers. You one of them? Maybe. 2 hours away from the cash show.
Refreshed.
Yahira has more. Hey, Yahira.
Hi, John. We start with the memory chip trade under pressure again this morning after, as you said, President Trump's comments on Iran. That's pushing down risk assets. And as of yesterday, these names, Micron, Western Digital, SanDisk, have entered bear market territory. And unlike other pullbacks where investors have quickly rushed in, this one has stuck, and it comes just ahead of SK Hynix's U.S. listing on Friday, and that is shaping up to be more than a test and a celebration of this AI trade. And no surprise that energy stocks are the lonely winners in this market as crude prices rise. We are seeing Exxon and Chevron all up about 2% in the pre-market after President Trump said the ceasefire with Iran is over. So investors now pricing the risk of supply disruptions, keeping crude prices elevated. And on the flip side, those higher crude prices are hurting the airline stocks, with United, Delta all falling in the pre-market as higher fuel costs threaten to squeeze margins and hurt the momentum these stocks have enjoyed. Airline stocks have been strong performers this year, with Delta up some 30%, nearly 30% year to date. So we'll see what they have to say when they report earnings starting next week. John?
Yara, thank you. Feels very reflexive, knee-jerk type stuff. The obvious places doing the obvious things going into earnings from Delta. Bramo later this week.
Yeah, and a real question about how much they can potentially edify the strength that we've seen going forward if oil prices remain elevated, or can they move past this? They talk about hedging. Do they talk about the robust nature of people going to places like Epic and Orlando and the World Cup?
Demand has been absolutely amazing.
Off the charts.
Off the charts for some of these airlines. Off the charts for the likes of Delta. And our radar this morning, our top story, the president declaring an end to the ceasefire with Iran.
To me, I think it's over. I don't want to deal with them anymore. They're scum. It's just a waste of time dealing with them. They're liars. As far as I'm concerned, it's over.
The president's comments coming just after a fresh wave of strikes against the country. Elsewhere, the president also taking game at allies.
Spain is a terrible partner in NATO. They don't participate. They don't pay. I don't want anything to do with Spain. Cut off all trade with Spain, please, including visits.
Spain refusing to commit to a defense spending target of 5%. And finally, President Trump renewing his push for control of, guess where, of Greenland.
Greenland is very important for the United States, but it's not important for Denmark. We shouldn't have given it back to them because we're the ones that need it. We need it for protection of the world, not just the United States. And it's very important.
The Danish Prime Minister maintaining that Greenland is not for sale. Things going so well in Ankara, Turkey. There's conversations of not having a summit next year in Albania.
That's exactly what I was going to say. The conclusion for all of these comments are simply, let's not do this again, because ultimately it's going to be really awkward, potentially in a place, Albania, that is not contributing its full 5% allotment to defense. At this point, not going so well, it seems like. What is that family photo going to look like? I was looking this morning. I know we got one, and I was looking to try to see just how awkward it was. At this point, the Danish Prime Minister is saying the U.S. position on Greenland is unfortunately clear. I would not be able to defend my people without NATO. At the same time, Greenland is not for sale. Spain is a very difficult situation. And frankly, that is actually the bigger story to me, because it raises the question of how united the European continent can be when they deal with the United States as a bloc, given the splintering of some of its members and the difference in how they deal with certain other nations like China. It just creates a lot of confusion for how unified Europe really can be.
President Trump, the greatest hits from Ankara, Turkey, at the NATO summit. Just amazing morning already. Crude surging then, with the president saying the ceasefire with Iran is over. This after the US launched, quote, powerful strikes and revoked a waiver allowing the sale of Iranian crude. Samantha down at Goldman Sachs is busy again. Sam, you had a rest for a couple of weeks. Welcome back. It's good to see you. What is the supply backdrop like right now? Let's start there. That's important because that's been a major factor in the past few months. What's it look like now?
Yeah, so the last time we had a flare-up, we had a decline in the crossings through the Strait. We're very likely to see that again now. But we have to also remember when we saw the MOU being announced, we couldn't expect going from 0 to 100 directly. I think right now we shouldn't also extrapolate that this is going to go to 0 and stop altogether. So let's give it a couple of days. The president also said that negotiations continue, that he thinks is a waste of time, but they continue. So to me, that signals that this is not necessarily over. Let's see what happens with the flows. And in terms of how high the flows were, just before this latest flare-up, we saw total Persian Gulf exports reach 70% of normal. So, by the way, this does include, to be fair, the reroutes, the pipeline reroutes from the region. But it was a pretty good rate of flow, considering how soon it was the MOU.
Where was that flow coming from, Sam? And how material was that waiver for Iranian crude, which has now been revoked?
Yeah, so if you look where the ships are coming from, it's from everywhere in the Gulf. It's not just Iran, it's not just Saudi, it's from everybody in the region. And if we consider the Iranian sanctions, even before this whole war started, Iran was selling crude. It just wasn't selling to everybody. It wasn't selling in an unsanctioned way. So it's not obvious to me that the revocation of the license alone is going to change this dramatically. We have to see where those flows go. I think the blocking of the Strait that was in place before, this is what we need to watch for. So going back to your first question, we need to watch the crossings. We need to watch how much that 70% of normal is going to fall to.
Do you have a break-even point of, say, the traffic goes up to 30% or 40% or 50%, that it would kind of even out and it would be okay, especially given your forecast, Goldman Sachs' forecast earlier this month, that potentially there could be a supply glut should there be more normalization for the Strait of Hormuz?
Yeah, that's a very good point. We're talking about flows having been around 70% of normal. And when we look at visible global oil inventories, they were starting to build. They were starting to build even though flows had not been fully normalized. And this goes back to something you guys mentioned just a minute ago, what China had been doing. And this, I think, to me, was one of the most surprising things since the deal announcement, is the fact that China oil imports in June, they kept dropping versus May. So they didn't rebound after the announcement of the MOU. And this gives the system a lot of flexibility. It makes it softer. It makes it easier to accommodate the flare-ups like what we're seeing right now.
If someone were in the markets and listening to you, you could forgive them for thinking, so you're saying I can ignore this? Are you saying that this potentially is not as disruptive of a development as it would have been treated, say, 3 months ago?
I think just like the blockade, duration matters. But I would be more concerned with refined products than I would be with crude. First, because we see this difference in terms of what China is doing. But second, because when we think of production capacity, crude production capacity, what we're hearing from the services companies is that this has not been damaged in the Gulf. So that's good news. That means that once this is resolved, production can likely go back to what it was. But the refining capacity has been damaged. So the ability of refined product output to normalize, I think, is going to take a lot longer. And already, even though, so I mentioned that China oil imports are continuing to move lower, but flights were starting to go up. Right? So mobility was starting to go up. So your consumption of refined products is going up before your production and your export of refined products. So I would worry a little bit more about gasoline and diesel and jet fuel than I would about crude right now.
So you can have a reset in crude, but you can still have elevated refined product prices.
Well, let's just think about how prices changed since the MOU announcement. So before this flare-up, we had seen crude down just about 18%. We had seen European natural gas down about, depending on the day, 5 to 9%. But oil products, they were down 4%. 5%. They were down the least. And I think this illustrates how tight that balance still is.
They're the things that consumers buy, and that's going to be a political problem in certain places.
I think that's exactly right. When we think about inflation, we don't buy crude oil, we buy gasoline at the pump, and the trucks buy diesel, and we fly on jet fuel.
Just a final question, Sam. Inventory levels. Clearly, they're very different now compared to where they were in late February going into the first mess. What do they look like now?
Yeah, so this is also a good point, and it goes back to the point on flexibility. On the crude side, they are not as low as what we would have expected at the beginning of the crisis. If we assume, the crisis lasts this long, it's going to go to record low levels. They didn't go to record low levels. But on the product side, the color we are receiving from market participants is that retailers indeed have very low inventory of that.
Samantha, it's good to see you. I have a feeling we'll be talking more again. Samantha Doubt there of Goldman Sachs. Got a brief rest, and here we are talking about the same issues all over again.
Well, and, Yair was going over the stocks that were moving, and the usual players pop as a result, and oil majors end up doing really well. Yesterday, Exxon reported earnings. Their second quarter earnings jumped by almost $4 billion as a result of higher prices. Why is it not being reflected in the stocks? And I do wonder at what point that's going to start to get baked back into some of these names, considering that you're not going to necessarily get the natural demand destruction that you would get from higher prices. In other words, they can keep selling at a much higher price point.
Brent crude this morning up around 6%, 78.50 on Brent. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The UK, France and Germany launching a $50 billion NATO initiative to develop long-range weapons without US involvement. The programme will develop strike systems to hit targets more than 2,000 kilometres away with pinpoint accuracy. French far-right leader Marine Le Pen intends to run for president even after an appellate court upheld her embezzlement conviction and ordered her to wear an electronic monitoring device. Le Pen will lodge an appeal to France's top court to delay her sentence and to allow her travel without the device. Hedge funds returning more than 7% on average through June 30th, the strongest first half performance since 2021. According to Pivotal Path funds focused on tech, led the way with a 27% average return. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, flooding the debt market.
The hyperscalers are issuing so much IG corporate debt. Value investing is indeed one place to hide, but it has to be value investing that's indeed protecting you against the downside risk.
Vishal Khanduja of Morgan Stanley joins us next, live from New York City. You're watching Bloomberg TV. Equity futures this morning negative by 0.7% on the S&P. On the Nasdaq right now down by 1 full percentage point. The Russell negative 0.85. In the bond market, yields bleeding higher. 2s, 10s and 30s. Yields up across the curve. 2s right now around 420. 10s around 450. 5% on 30s. Pushed higher by this move in crude. The president says the ceasefire is over, but negotiations might continue. We'll try and translate that for you. We'll catch up with Annmarie in Ankara, Turkey in about 15 minutes' time. Brent crude at 78, WTI at 74. Big question for this programme this morning, just how live is that meeting at the Federal Reserve and at the ECB, by the way, over the next few weeks?
And the answer seems to be much more likely to be live at the ECB than the Federal Reserve. But of course, the Federal Reserve is a big black box where you have no clue, considering the fact that the reaction function has been killed. Some people speculating that because the task forces are active, they're not going to make any kind of move. Nonetheless, it is going to be an increasing discussion, and currently that's what's being priced into the market.
So it's one leg of the bearish story this morning, the move in crude. The second piece of it is a vicious rotation away from chip stocks in the last couple of days. And then some debt issues in the last 24 hours that have received a bit of pushback. The latest this morning, Amazon getting a cool reception to its latest debt offering, taking AI-related debt sales this year to 335 billion US dollars. Double, more than double, what we saw through last year. Vishal Khanduja of Morgan Stanley writing, we continue to be underweight the tech sector and don't anticipate changing that until there is further clarity on CapEx need. Vishal joins us now for more. Vishal, good morning.
Morning.
Let's go with what we got from Amazon yesterday. Bit of pushback, underwhelming, I would suggest. How would you frame that offering?
Significant pushback, significant surprise. We thought that they were done for the year, almost done for the year in terms of coming and hitting the debt markets, especially IG. This is typically the blackout period. Probably in the end of this month, beginning of next month, they have earnings, and all the AI hyperscalers do, hitting another 25 billion, saying that they're done for 2026, but then caveat being they could front load 2027 CapEx spending. So that is a moving target. And I think the loss in the shuffle was pretty significant pushback from the market, not just in terms of the amount of order books, 63 billion down to like 42, and they priced 25. But there was about 20 to 25 basis points of pushback in the long end yields. Translate that into bond points, it's about 3.5, 4 points of downside that existing bondholders took if you were a spread-based buyer. If you were a yield-based buyer, yesterday was fantastic. You got another 6.10, 6.25 coupon that you could hedge your liabilities on the other side and still get a AA type balance sheet. So again, no pushback on fundamentals, but the technicals and the clarity is needed.
I think this question is relevant to both the equity investor and the debt investor right now. That pushback that you're getting to additional supply, do you see it shaping outcomes? Will it shape the approach to CapEx from here?
Not really. So I think that is what it is. I think I compared this, and we were having a chat on the desk. This is compared to a homeowner getting a 30-year fixed 3% mortgage on the asset that's the biggest asset on their balance sheet. Money is still very cheap for these AI hyperscalers. Again, to give them a lot of credit, over the last 10 years, they've built fortresses of balance sheets. So they will have much more demand than the US Treasury for the long end debt at the moment. But the compensation will keep pushing up as debt holders like us, who are more spread-based buyers, almost run over by yield-based buyers over the last 1 year, are going to keep pushing back in terms of how much we will need in total return type portfolios rather than yield-based portfolios that we manage.
The comparison that you made to the U.S. government is a salient one, and it raises a question heading into a 10-year auction later today and a 30-year auction tomorrow. How much is the pushback that we saw for the Amazon debt issuance a pushback to AI debt issuance versus just debt issuance at large from any particular place?
A lot of that is that. And I think the overcrowding effect that we talk about, I hope some of that will show up in our equity counterparts will face the same trouble or forces back up. If you go back to U.S. Treasury issuance, 2002, I think was 22% in the U.S. aggregate, which is a benchmark that all of us follow closely. It's about 46% now. So overcrowded out corporate issuance, spreads were tighter, balance sheets were stronger, and now you're starting to see a little bit of that come back into the market where corporate issuance is starting to pick up. Also, I think we want to keep in mind that a lot of the issuance that happened by corporates post-COVID, 2020 to 2022, is coming due some of the front-end debt. So you will have the net supply or the gross supply from this refinancing is going to be $1 trillion a year for the next 3 years as well. So quite a bit of debt coming from the corporates on the other side as well. So yes, going back to your point, it's a lot of debt supply overall rather than just corporates versus treasuries.
What's safer in your view right now, the investment grade market or the high yield market? And the reason why I ask this is because the investment grade market has an increasingly long duration at a time where people view many years as being a high risk because of the nature of the moment that we're in. Yeah. High yield has a shorter term. And a lot of the companies, particularly in the high end, are actually being able to fulfill it much more quickly. Where is the risk right now?
Yeah, so it depends on what you're trying to extract out of the bond market. If you're a total return investor, go for the shorter, spreadier, higher yielding name, a double B or single B credit. Again, spreads are almost at levels that you will balk, but overall yields are extremely attractive. So you are reducing your spread duration, but increasing your DXS, duration times spread. On the other side, if you're a long-term liability manager, a AA balance sheet for 30 years, if you can lock in 610, 625 yields. Now, I think if you go on, the other hyperscalers are 7-handle yields.
Assuming it's a AA balance sheet in 30 years.
Exactly what I was thinking.
I think it's if you look at the cash flow, I think what these balance sheets have done over the last 7 to 10 years, there's quite a bit of strength that they've built up. Now, a lot of it then depends on the robustness or the durability of AI. overall. I think who are going to be the winners, who are going to be the losers. And yes, we're already seeing, I think, some of the BBB balance sheets struggle in that AI hyperscaler.
Can we finish on another AA credit, the Treasury? Crowding out is this phrase that we've heard a lot. You mentioned it as well.
Yeah.
That so much of this issuance might be at the expense of the Treasury market. Do you see it the same way?
I think we are starting to see, but I think the size of the markets are extremely different at this point, like 28, 29 trillion on the other side versus I think you're still seeing like $1.5 trillion on a gross supply basis. Net supply is much lower on the US corporate side or the global corporate side if you include the European corporates as well. I think the word is starting to come up in our investment meetings on that size, but the size differential is too significant right now to have them compared. It's like comparing US Treasury nominal market with the TIPS market. We love to talk about it, but it's 6% of the overall issuance.
Do you consider additional supply on the equity side as part of the story, though, the forces that you have to consider?
Oh my gosh,
that we're seeing
absolutely.
on both stock and debt.
Absolutely. And us IG debt holders on the other side, we are pushing these companies to you guys need to tap that market too, right? AI CapEx needs to become in, and we have much less upside in this versus the equity holders.
Do you think that's where the issuance will come from then?
We definitely think, I think post this earnings cycle, I think you'll start seeing plans for equity issuance and convertible issuance starting to be tapped.
Just imagine if we get what Meta talked about a month ago. In the FT, that report came out that Meta might do what Alphabet did and the stock sold off. In fact, you could argue that the stock has rebounded because they've not done that. In fact, they're considering doing something completely different. What if we actually started to see that?
Yeah.
Is that what we're underestimating here, that they might come and tap this equity market more than people believe?
Why wouldn't they? I mean, at a certain point, if the debt market is starting to get a little bit nervous, or at least the funding conditions aren't getting as good, you're going to tap the equity market. I keep going back to what the capital markets professionals that we have on the show say, the bankers. They say, markets are not sort of distinct anymore. It's a whole market solution for different companies that want to raise so much debt that it's changing the game. So it's not just looking, I need to raise this many bonds. It's, I need to finance $30 billion. How do I do it? And increasingly, you're going to have to look at equity markets and whether they are cheaper or more expensive for a potential company to borrow or to get money to raise cash than the bond market. And ultimately, that calculus will change exactly where the issuance comes.
You heard what basically Vishal just said. It was just basically, look, the hopes and dreams, you get paid for the upside in the equity market. Stop coming to us. And if you come to us, you're going to have to pay up. High yield.
And right now, that's what you're seeing with Amazon. I wonder what this means for OpenAI and Anthropic, because they're lining up IPOs. And the expectation is they'll do just what SpaceX did, which is IPO and then issue debt. So at what point will that sort of 1-2 punch for financing not have the same punch that it did, say, a few months ago?
Seen how that market responded to that SpaceX debt. How's that trading right now?
Not 5-7 points lower. So again, depending on what you wanted to extract out of it, you're still getting 7.5 yield on the long end. But on a total return basis, I think the bonds are down 7 points.
Vishal, it's good to see you. Thank you, buddy. Appreciate it. Vishal Khanduja there of Morgan Stanley Investment Management on the amount of debt supply we've seen, including Amazon, but elsewhere too, and equity as well. Later in the week, SK Hynix, $28 billion, tapping the US equity market to raise capital.
Yeah, everybody's doing it, so why not come here? And it looks like the deepest, most liquid market will look favorably. Of course, the correction isn't a good look heading into that with the Kospi.
Nasdaq futures recovering just a bit. We're down 1% on the Nasdaq 100. Up next, we'll catch up with Tracie McMillion of Wells Fargo, Luria of D.A. Davidson, Scott Chronert of Citi, the third hour of Bloomberg Surveillance. Up next.
Tech is still long-term leadership, but it's changing within.
You have investors sort of hopscotching back and forth between these themes.
We're going to continue to see these mini pockets of rotation.
This kind of digestion is completely normal, and frankly, we'd argue it's healthy.
Overall, it's still constructive for the entire AI trade.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now in your price action. The scores look like this. Down 0.75% on the S&P, recovering just a touch on the Nasdaq. We're down by a little more than 1 percentage point. In the bond market, yields a touch higher. Stateside, much higher. Worldwide, on a 2-year this morning, up a basis point or two. Twos at 420. In the UK and Germany this morning, up by double digits, up by 10 basis points. This move in crude Setting the tone for this market this morning, WTI and Brent up by more than 5%, Brent at 78, WTI at 74. A question for us this morning, where does it leave these central bank meetings this week? 2 central bankers out of Europe in the last minute alone saying we've got no idea what we'll do in 2 weeks' time.
Yeah, the Bundesbank president Joachim Nagel coming out and saying that after today's Iran news, we're back where we began. It has a meeting-by-meeting approach, and we have no idea. He has no idea what they'll do at the July meeting, but it is appropriate to have a meeting-by-meeting approach and to take the data as it comes. So that's about as clear as mud. Isabel Schnabel back in Monday talked about how this pressure is going to lead them to tighten more. So if you're pricing in more potential hikes in Europe, they're giving fuel to that with some of the commentary this morning.
You've said it a number of times. Single mandate central banks far more sensitive to this move in energy, even a back up towards, let's say, 80. For the US, different reaction function. I've got no idea what the reaction function is right now at the Federal Reserve. What on earth do you price in off the back of that?
You know, that's the reason why you're seeing a more tepid response, maybe in the front end of the U.S. yield curve. But it's also that the U.S. economy is less dependent on oil and gas than the European one. So it's a twofold issue. Number one, the European Bank has been a lot more clear about their mandate and their reaction function to it. But B, there is a real question, given the fact that the U.S. has seen buffers and actually profited from the exports of oil that is offset to some degree and potentially offset the need for increasing prices to the degree.
You know how people feel about this moment this morning, don't you? They've just done this for like 3-4 months. They're so done with this. To see this again. And even from the president this morning, when he turns around and he says the ceasefire's over, and then says something about negotiations potentially continuing with negotiators. Like, what do you do with that? Yeah,
the idea that he's saying, in my mind, it's over. They can do what they want with that. And at the same time, you start seeing that the main economic tenet of this agreement, the waiver to the Iranian sanctions, was removed. So in other words, the ban on Iranian selling oil has been reinstated. So it does seem like the memorandum of understanding has been undermined in a more significant degree than any other time. That said, people have reshaped their understanding of the oil market, particularly with China and the response function there. And as far as markets are going, they're saying, just tell me what semiconductors are doing, tell me what the Kospi is doing, tell me what Amazon's going to do next, tell me when we can finally price in whether we've got more legs to the AI trade or not. And that's all I really care about.
I'll tell you what Amazon might not do, and that's issue more debt anytime soon.
At least not this year.
Based on the reception that got in the last 24 hours. Crude this morning then up 5%. 78 on Brent, WTI at 74. Coming up this hour, Tracie McMillion of Wells Fargo. As stocks rotate away from the chip sector, Luria of D.A. Davidson on why he believes the sell-off is overblown, and Scott Chronert of Citi on the opportunities under the surface in the equity market. We begin this hour with our top story. The president saying the ceasefire with Iran is over.
To me, I think it's over. I don't want to deal with them and with this scum. It's just a waste of time dealing with them. They're liars. As far as I'm concerned, it's over.
Annmarie joins us now from the NATO summit in Ankara, Turkey. Annmarie, welcome back to the programme. The ceasefire's over. Are the negotiations over too?
That's a great question, Jonathan. I think everyone waking up this morning is trying to understand, is this a pause, maybe a prolonged pause, or are negotiations really dead, given the fact that President, with some hot rhetoric at day 2 of the NATO summit here, saying he's pretty much done with these talks. It's a waste of his time. But he did give a window to his negotiators saying they could keep talking, even though he thought it was pretty much a waste of their time. So that's the question everyone has right now. And obviously, there are 2 parties to this. So we would have to see, I imagine, for the United States, see evidence that Iran is truly willing to stop with some of the aggression we've seen in the Strait of Hormuz, for the president to be willing to come back to the negotiating table. You have to think at some point, is this just part of the pattern we've seen when it comes to the fits and starts, whether that's skirmishes within the Strait of Hormuz or even the negotiation talks, or is it truly over? And then where does that leave us? That's another question. Are we potentially going to see more airstrikes like we saw overnight continue? We also saw Treasury lift the waivers they had given to the Iranians to be willing to sell that crude. How long are we going to be in this new period of paralysis, really, when it comes to the tit-for-tat between Washington and Tehran?
Annmarie, as you know, the president has had plenty of opportunities over the last month to end this ceasefire. Repeatedly, the Iranians have tested his patience and really threatened to cross a line. The president's declared the end of ceasefire at a NATO summit in Turkey, surrounded by European members he's been incredibly disappointed with. How instructive do you think that is? Why he chose this moment, this time, in this place?
And what he's saying in public, Jonathan, we've learned he's saying behind the scenes when he met with those world leaders. I think you need to take a step back and be a little bit critical or cynical, in me, is looking at this as, would the President of the United States let a good crisis go to waste? In the sense that if he was waiting for a moment, as the Iranians have continued to test him, if he was waiting a moment to respond in kind to their aggression in the Strait of Hormuz, for the President of the United States, what better opportunity than when he's surrounded by NATO allies to see, one, who steps up to the plate, given the fact that Iran has been really the latest source of frustration between Washington and many of the European allies. So he would learn something from that. And potentially, two, to show the Europeans that this issue, even though they're in the middle of these nuclear negotiations, isn't exactly going away, given the fact that the president will say the regime has changed. It is still the same sort of regime, different management, but has the same sort of directive. So this is the opportunity the president potentially used to show the European alliance and the NATO allies that the United States actually can't do this alone, and they're going to have to be willing to step up. And this is now really overtaking the talks that are happening today.
Annmarie, we'll talk about the energy story with you in about 30 minutes' time, so stay close. Annmarie with the latest at the NATO summit. For the equity market, we've been covering this all morning. It's not just the shock in energy over the last several months and the bounce we're seeing so far this morning. It's the firming up of rate hike bets at certain places like, say, the ECB, and a big rotation within the equity market. Here's the view on Wall Street this morning. Tracie McMillion of Wells Fargo writing the following: the equity rotation amid strong earnings growth is healthy. Still, headwinds likely prevent a straight line higher in the S&P. Energy, gold and metals prices are not done rising. Tracie joins us now for more. Tracie, oil is not done bouncing. It's up 5% so far this morning. That's the bad news. The good news is nowhere near triple digits. We've had that big reset over the last month. Tracie, the recent developments this morning, do they change your view on this equity market?
Good morning, John. So when I wrote that yesterday, I wasn't expecting a large portion of that rise to occur overnight, but we do have a price target of $85 a barrel on oil at the end of this year. So we think there's probably some more upside to oil as we move through the rest of this year. It doesn't necessarily change our opinion on equities or fixed income, but it just reinforces the fact that there are still geopolitical risks out there, and the market needs to take them seriously.
Earlier this year, Tracie, the response to geopolitical risks seemed to be to hide out in the AI stocks. At what point has that dynamic changed, given how high the valuations have flown with some of those names, the rotation underway, and how people seem to want to see a broadening out, and yet how much of that is predicated on the disinflation and the calm persisting in the Middle East?
Yeah, so we do think that the AI trade will continue to find support in earnings and in margins, but investors are being cautious ahead of the earnings season. So if we fail to see the kind of spectacular earnings that we saw last quarter, then that could be a problem, certainly for those stocks and for the broadening out, which includes sectors that are ancillary to the AI trade. But we think that we will see support there over the coming quarters, and that can keep that trade alive. So we're favorable information technology, but would buy on pullbacks. We're also favorable on utilities and materials for the role they play.
Tracie, we've been talking, and John started the show talking about this three-pronged threat to the risk rally that we've seen, whether it's questions around stickier inflation due to oil, whether it's questions around the rotation away from semiconductors, or questions about the debt that is seeing a bit of a tepid response from debt investors. We saw that from Amazon. From your perspective, have you seen a tone shift that makes you nervous?
So it doesn't necessarily make us nervous. In fact, as we wrote, we think that the rotation is a healthy rotation, and the tone has certainly shifted from what we were seeing at the height of earnings season. But again, it's good for investors to question valuations. It's good for investors to look for other areas of the market that might provide better performance as we move through the coming months. We do think the summer summer is going to be volatile, and that will give investors the opportunity to reposition their portfolios.
I was thinking of you and the team in the last couple of days, Tracie, because the banks trade is starting to work, and it was a core overweight, big piece of your outlook coming into this year. Record highs for the S&P 500 banks just a week out from the earnings, Tracie. Why is that trade starting to work just beyond, say, Morgan Stanley and Goldman Sachs?
Yeah, it's starting to work really, especially for the larger banks. They're benefiting from increased portfolio management fees. They're benefiting from investment banking fees. And we also think that they will benefit as we see a steepening in the yield curve. That's yet to come, but we still think that that is part of their story. Deregulation is also part of their story. So we continue to have a most favorable viewpoint on financials.
Tracie, appreciate it. Thank you. Tracie McMillion there of Wells Fargo. Next Tuesday, the financials, a handful of them, like 5, all reporting on the same morning, including, of course, JP Morgan.
Yeah, how much of a read will we actually get? What I really want to know is the pipeline and whether it has shrunk at all as some of the pushback has increased with some of the debt issuances. Have you seen the opportunity decline in some capacity as a lot of these companies see the reception that Amazon got? Or is this essentially still a wide open market? That might really set the tone.
I don't see him backing off. Do you? Do you
Not
see him
at all.
backing off?
I don't see anyone saying that this isn't worth it. And right now, it's just about which financing is cheaper. Question is, how much do markets start to converge? Do equity markets and bond markets start to push back at the same time, really pressuring both levers of the financing curve?
We'll catch up with Ed Ludlow in just a moment. And Ed called it a race for capital. And we asked the question, when does it become a competition for capital? And I think you can make the argument now, based on the moves we saw yesterday in the secondary market and the reception that Amazon got, the reception that SpaceX got, the move you saw in treasuries, that increasingly this is becoming a competition now for capital. And there are trade-offs, and you will have to compensate investors accordingly.
And right now you can see that competition broadening out. The New York Times reporting that Blue Origin just raised $10 billion to a north of $100 billion valuation. It just highlights how much every company is, oh, you can raise money for space? Hey, we can throw our hat in the ring. And essentially that's what's happening.
Features this morning recovering. We were down by about 1% on the S&P 500 when this show went live. This morning we're down by 0.5, so we cut those losses in half as we get closer to the opening bell. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The Trump administration lifting restrictions on OpenAI's newest model, GPT 5.6. Axios reporting the ChatGPT maker will make its most powerful model series available to the public Thursday. Microsoft is replacing OpenAI and Anthropic with its own models in software products such as Excel and Outlook. Sources telling us here at Bloomberg, Microsoft's goal is to ultimately eliminate the cost of using Anthropic models. In sports, Switzerland advancing to the World Cup quarterfinals after beating Colombia 4-3 in a shootout. And Argentina making a late comeback to beat Egypt 3-2. The two will meet on Saturday in Kansas City, Missouri. Argentina looking to win back-to-back World Cup titles. And that is your Bloomberg Brief, John.
Vonnie, thank you. Thank you for the update. More from Vonnie in about 30 minutes' time. Up next, the Morning Calls Plus. Gil Luria of D.A. Davidson on why the sell-off in chips might be overblown. A 16% move lower off the highs of June. We'll catch up with Gil in just a moment. Live from New York City this morning. Good morning.
This has been an earnings-led melt-up, and I'd rather have an earnings-led melt-up. I think there's less downside than there is in a FOMO melt-up. The fact of the matter is earnings have really justified the rally in semiconductors, and it's not just expectations, but it's expectations based on actual reality. I would view this sell-off more as an opportunity than a reason to panic.
That was Ed Yardeni of Yardeni Research. It's kind of amazing, isn't it, that we had this close to 90% rally in Q2 for semis, a record quarterly rally for many of those names, and yet valuations for most of those names didn't actually go up for many of them. In fact, Valuations came down because earnings were so powerful.
Samsung's the perfect example. And by the way, Samsung shares rapidly sold off after these earnings, a 19-fold surge year over year when it comes to profits, driven by just how much demand there has been for the memory parts, the memory chips tied to AI. And yet, crickets, or worse than crickets. It raises a question, how do we even understand valuation at a time of a hyperbolic move, of something where it does go to the moon? That, I think, is what the market's grappling with.
The bubble is not in the price, maybe it's in the earnings. This is something that I heard from Liz Ann Saunders of Charles Schwab. Not a statement, a question, and something worth considering. How durable, how sustainable is this earnings story at so many of these names?
Memory tends to be a cyclical story because ultimately people produce more and then all of a sudden there's a glut, and at some point that's going to lead to lower prices. The problem is for a lot of people is that you don't have visibility as to when that kind of glut moment is going to continue. And right now people are trying to build as much as they possibly can, and there seems to be insatiable demand. That's the reason why we keep asking, at what point does some of the pushback from debt investors lead to a reduction in CapEx and a potential pullback in the profitability for some of these chip companies?
These earnings are the consequence of what we have called a major wealth transfer from the big spenders to the chip players. And they are going to the debt market now, to the equity market, to raise capital, to keep that spending up, just as the market is starting to push back just a little bit on the margin in debt, in equity. We'll get to that in a moment. Equity futures right now in the S&P down by 0.5. We were down 1 percentage point earlier on this morning. So as the session grows older, things improve just a little bit. On the Nasdaq, we are lower by 0.8%. The opening about 1 hour and about 11 minutes away. That's the price action. Here are the morning calls. First up, Evercore raising its price target on Dow to 500, citing increasing positivity around the company's AI build-out. Your second call from Morgan Stanley, trimming its price target on Alibaba to 180, expecting cloud acceleration to beat market expectations. That stock is up this morning by 9%. And finally, TD Cowen cutting its price target on Amazon to 340, seeing faster growth for AWS and expanding margins in North America. Yet still this morning, that name is down by 0.9. Let's stick with Amazon, the tech giant, facing a cool reception to its latest debt offering as companies look to fuel AI spending. Ed Ludlow has the latest. Ed, good morning, buddy.
Good morning.
What was the latest for you, the reaction that you and the team had to that very cool reception to that debt offering?
Yeah, a little bit of AI debt fatigue. You know, just think about how it played out. Peak order book, $62 billion, and then pricing tightened and it netted out at $41 billion of demand. They were easily able to raise the $25 billion, sell $25 billion worth of bonds. And like Amazon's done $107 billion of bonds over the last 12 months. In this case, $25 billion is 1.6 times oversubscribed. The average in US IG over the last period, 4x. Think about like Amazon in March, 3x, Alphabet, Meta, and Oracle. So like there had to be some kind of concession made, but they easily raised the capital. They easily did the deal. And I think if you read a lot of the strategist reaction, like the expectation is they will just come back again next year. Maybe this was a little bit about pull forward of their financing for 2027. Maybe it wasn't. But it's just interesting, the reception to this, when you take it in aggregate of all the activity that Amazon in particular has driven over a 12-month period.
Ed, you're the tech guy. We're the capital markets people.
Yeah.
And I'm looking at capital markets. Lisa and I, throughout this morning, looking at the pushback we're getting on both equity and debt whenever a company looks to raise capital or actively raises capital.
Yeah.
And we're asking the question, will that shape CapEx intentions? Now, from a capital markets perspective, you'd have to ask that question. It's an obvious one. But from your perspective, do you think we're underestimating the desire to push forward from this and keep raising capital and keep spending?
Well, the thing that we don't talk about as much is why is capital expenditure going to go up? It's not because there's like more stuff. It's always framed in the context of demand. So we're going to build more data centers because we need the compute power to facilitate all the demands run AI workloads. Yes, in part that's true. But capital expenditures also go up because the cost of building those things is higher. It's not just memory chips that are driving up inflation on the data center side. We have labor and construction inflation. That is just true out in the world. So that's kind of what's interesting. And how you guys framed what happened with the Samsung post-earnings reaction in the markets is absolutely spot on. Nothing has fundamentally changed in the memory chip market in the last 48 hours. Exactly the same. The thing is that the market's kind of saying, I think a lot of this future AI growth had already been priced in. You talked about that record quarter and where valuations netted out. It's kind of interesting to say we kind of knew this, right? We know what the state of the world is. But I think we should talk more about like the cost of doing business for these AI companies is greater, not necessarily they're pricing their own CapEx growth based on demand at this point.
Prices are going up. Ed, it's good to see you. Looking forward to the show. Bloomberg Tech, a few hours away with Ed Radlow. Chip stocks then struggling to find a firmer footing over the last few days. Gil Luria of D.A. Davidson pushing back, saying the market being on edge about the AI trade is not an indication prospects for semi companies have changed at all. Gil joins us now for more. Gil, welcome, sir. Let's get into it then. Why is the narrative shifting?
Because that's what it does, right? So 6 months ago, anything in AI was great and AI was going to take over the world and software companies were useless and everybody bought the SMH and sold the IGV. And now, for whatever reason, the pendulum is swinging back and people are buying IGV and selling SMH. There's not a lot more to it than that. There's a tremendous flow of news and data points, but none of those has really indicated there's a change in demand. The conversation you were just having, this is mostly driven by demand. We are using the AI tools more. They are getting a lot better all the time and seem to be continuing to get better. You pointed out OpenAI doesn't even have its latest model out yet. Models are getting better. We're using them more. We need more tokens. Demand is up. That's why everybody's building data centers. None of that's changed. Just sentiment, just selling the news, just the pendulum swinging back. And that creates opportunities because there's a lot of dislocation in semis. There's semi stocks that are too expensive regardless of what happened. Your Intel, your Cerebras. There's semi stocks that are trading as if we're already past the peak. Your Nvidia, your Micron, and that's where the opportunities are. Buying Nvidia at a sub-market multiple, buying Micron at 7 times earnings. If we're using AI at all next year, those two stocks are very well priced right now.
Do you think it's fair, though, Gil, to say that we've seen peak profit margins based on the pushback from some of the hyperscalers and cost?
Percent margins for Nvidia may stay stable in the 70s. Percent margins for Micron may not be higher than the high 80s. They may settle down somewhere in the 80s. But the top line growth means that that's still very significant earnings growth. Back to the conversation you were...
Too bullish.
What's that?
Kill the mic. He's too bullish. Gil, tell us what your top pick is right now then. Pick up the pieces. Where would you go?
So on the semi side, it is Micron and Nvidia. On the software side, it's Palantir and Microsoft. Those two are the orchestration layer for AI. So companies are not going to build directly on Anthropic and OpenAI because they're going to have their plug pulled on them, just like happened a couple of weeks ago. So they're going to want to build their business on top of an orchestration layer, a part of the stack that allows you to switch models. And that's what Microsoft already does for us with Copilot, and that's what Palantir does for their customers. Those two will also introduce more open source models, which will help companies manage their expenses.
Hey, Gil, thank you, buddy. Appreciate it. Well framed.
Thank you.
The bull case from Gil Luria of D.A. Davidson. Up next, the latest on energy. The latest from the NATO summit in Ankara, Turkey, with Bloomberg's Annmarie. As the clock gets further away from the Asian and European session and closer towards the start of the opening bell stateside, equities do recover. We're down by just 0.5% on the S&P 500, down by 0.75 on the Nasdaq. The tech story, a big piece of this, and it will be a big focus for us into the opening bell. In the bond market, yields were higher by 2-3 basis points, now up just by 1, not even at the front end of the curve at 4.19. Crude was up by about 6%, now up by about 4. Brent and WTI. Brent crude this morning, 77, up 4.3. Similar move on WTI at 73. This move is settling down just a bit as we get closer to the cash open stateside.
We've had a lot of investors on this show. Not one of them has come out and said we're selling everything. Not one of them has said, actually, we're a little bit concerned that this is actually going a little bit too far and that risk sentiment is completely upended. In fact, more of them are coming out, whether it's Tracie, McMillion, or others, saying, honestly, it opens up opportunities. We just heard Gil Luria talking about how this is an incredible buying opportunity for Nvidia and Micron and others. And you just start wondering, is it sort of that U.S. investors are predisposed to be optimistic, or is it that investors are just so conditioned to be bullish in a market that has only gone in one way this year.
It's a correction, but a healthy correction.
Obviously.
We had an 80 to 90% move on chips. We've had a 15 to 16% move lower. Okay.
What's healthy about that?
A rotation within equities,
like
not a rotation out of equities.
Rotation from sugar?
You know how
to
this
fat.
works. You know how this works. Right? Things are okay.
I know, that's what a lot of people are saying. And they're saying if you look at yesterday, we saw the hyperscalers actually gain value. You saw equal weight continue to perform better, lose less than the rest of the index. All of this pointing to a healthy move. Key question is going to be how far this oil rally goes and whether it does upend expectations, not only for central bank tightening, but for the profitability of some of the other companies, the 493 or, whatever number it is now, that potentially have gotten left behind.
That opening bound just around the corner. 60 minutes away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing the chip trade under pressure this morning, but as you said, the risk-off mood is settling down. But as of yesterday, these names, Micron, SanDisk, and Western Digital, all entered bear market territory. And what has been different is that other times during pullbacks, investors have been quick to rush in, but this time it has stuck, and it comes just as SK Hynix gets ready to list on Friday on the NASDAQ. So it will be a real test for investor appetite for memory. Turning to oil, of course, that is surging due to President Trump's comments on Iran, and that is helping to lift the energy stocks, though they are trimming their gains. ExxonMobil, Chevron now up just under 2% in the pre-market after President Trump said the ceasefire with Iran is over and expressed disdain over toward Iranian officials. So that caused investors to once again price in the risk that any disruption to supply could keep energy prices elevated. Though, as you said, we haven't seen the outsized moves that we saw earlier in the conflict. And a legal showdown is brewing between two chip makers, and that is why we're seeing Nvidia shares falling just under 5% in the pre-market after its rival Wolfspeed filed a patent infringement lawsuit alleging that a broad range of its products violate 5 of its patents. Nvidia disputes the allegations and says it plans to vigorously defend itself, though this one as well is trimming its losses. John?
Yahara, thank you. Thank you for this morning. Some of the morning movers, the single names to look for going into the cash open. Let's turn back to our top story. The president saying the ceasefire with Iran is over, sending crude higher by 4%.
We have to also remember when we saw the MOU being announced, we couldn't expect going from 0 to 100 directly. I think right now we shouldn't also extrapolate that this is going to go to 0 and stop altogether.
Annmarie is travelling with the president in Ankara, Turkey, and joins us now for more. Annmarie, the energy piece of this is critical. What is the setup now in this moment compared to where we were several months ago?
Well, even, Jonathan, where we are just 24 hours ago, you have naval forces, U.S. naval forces, basically saying the threat level now in the Strait of Hormuz has moved from substantial to severe. So where we were with the signing of the MOU, you have vessels now once again having to question whether or not they should traverse the strait. We did see some movement following those attacks yesterday by the Iranians on 3 vessels. But when it comes to LNG vessels, those have basically stopped. So now if you are a company and you're thinking about doing this, you need to weigh, is it worth the risk right now, given the recent escalation over the past 24 hours? And if you decide to do so, which route do you take? If you decide to go on the route that the U.S. forces are backing, that really hugs the Omani coast, well, potentially you're going to have the backing of the U.S., but that is the route that we have seen more aggression from the IRGC. Then potentially you can go on the route that's more of the middle of the strait, but the issue there, of course, is you have to get approval from Tehran, and that could put you at the crossfires of the United States. So this is potentially going to be the problem. As we saw an uptick of more vessels since the signing of the MOU in June, potentially is that going to start to trickle down now, given what we've seen, and the president right here in Turkey saying he thinks it's been a waste of time in terms of the negotiations, and at the moment he thinks the ceasefire is pretty much over.
Annmarie, you got to the heart of it, though. That's the issue. It's not about whether you transit the Strait of Hormuz. It's how you transit the Strait of Hormuz. And if you choose to hug the coast of Oman, then Iran's going to make life difficult for you because Iran has other ideas. They want you to go through their desired path so they can charge you a fee. Isn't that ultimately what's up for debate right now?
Absolutely, and that's an international waterway. So the United States, the Saudi Arabia, the UAE are not, the Europeans, Qatar are not going to sign up for that. And this is where the problem is. Iran is still trying to have that control over the Strait of Hormuz by making it incredibly difficult for ship owners to go through the route that's U.S.-backed closer to Oman. And then if you go the safer route, potentially when it comes to the regime, then you need their approval. And in the end, that would mean that Iran is still having this control over the Strait of Hormuz, deciding who gets to go through and potentially most likely charging fees to be able to allow that passage.
Annmarie, before you go, this summit now consumed by this single issue. Today was meant to be about something else. I have no doubt the Europeans wanted to make it about Ukraine. Where's that issue now?
Well, we're waiting for the president to sit down with President Volodymyr Zelensky. The agenda is definitely behind here in Ankara. Ukraine was supposed to be top of the agenda today, as well as defense spending, making sure NATO 3.0 actually happens and all of these countries start hitting 5% of GDP targets to be spent on defense. This is still going to be an incredibly important meeting. I spoke to the Finnish president yesterday, Alexander Stubb, and he said NATO should be able to deliver, and he hopes they could deliver more Patriot defense missiles right now for Ukraine. You've seen some of these fresh strikes from Russia on the eve of this summit that Ukraine has not been able to defend. There's been one issue that has been floating around for months, potentially a license agreement that Ukraine will be able to produce this at home in country. And I imagine Zelensky is going to ask the president for that sign off today. We'll have to wait and see what comes out of that bilateral meeting as we wait for them to sit down.
Annmarie, it's good to see you. Always good to catch up in Ankara, Turkey, following the NATO summit and the moves of the President of the United States. For 4 years plus now, the NATO summits have been consumed by supply-side shocks, which have reshaped energy markets and informed us all on where central banks might turn. It was Ukraine and these aggressive rate hikes we had coming out of the pandemic, and now we're playing the same game in Europe with a war in Iran.
It seems like the solution to all of the potential animosity between the members of NATO and this question that is existential about just supply is simply not to have a 2027 NATO meeting, which seems to be what's on the table right now, to possibly stave off some of the awkward moments.
Why would you?
I mean, I don't disagree. I mean, at a certain point, what's getting accomplished? I mean, you do have this pledge of NATO members to support Ukraine until 2027. But ultimately, what have we actually accomplished other than some of the highlights that you played in terms of igniting tensions for Greenland, with Spain, and potentially with Iran with the end of the ceasefire?
We had an energy shock in Ukraine coming out of the pandemic. Everyone hiked rates. We had an energy shock in Iran this year, and the ECB hiked rates. In 2 weeks' time, there's another ECB meeting. In a few weeks' time, there's another Fed meeting. Mike McKee is on the ground in Jackson Hole, which is an interesting place to be right now, Mike, because in a few months' time, there's going to be a massive focus on where you are. Mike, walk us through what you're doing and how this conversation might change again into this meeting.
Well, basically, this is the Teton Economic Outlook meeting. It's people from Wall Street and economists talking about what they think is going to happen. And of course, by dinner time last night, after all the headlines of the Iran attacks, everyone was up in the air about what was going to happen next. And nobody really had a good idea about where the markets are going, where the oil markets are going. This is another one of those situations where they just have to sit and wait, which is kind of the situation that the Fed finds itself in. We get the Fed minutes today of Kevin Warsh's first meeting, and that's going to be a little difficult to decipher because the problem with the minutes has always been that they're 3 weeks old, so it's looking backwards. And now we seem to be in the same position that we were when they had their meeting 3 weeks ago. Oil prices going up, the conflict increasing, and what they do about it, we don't know. So I guess the question today with the minutes is, did Kevin Warsh make any changes in the format of the minutes, or did they take out anything that might be construed as forward guidance?
Mike, you nailed it. Typically, we talk about the power of the pen. What about the power of the edit button, the power of the eraser? How much power does the chair have to massage the minutes?
The chair has power by tradition, but not by statute or anything like that. Basically, what happens is after the meeting, the minutes get written up by the staff of the Fed and then circulated to all of the bank presidents and governors for their comments. It gets edited. And then, after 3 weeks, it gets put out after all of them vote, what they call a notation vote, just basically, is it okay with you? If there were any dissents, that would be interesting. But it's also true that probably Kevin Warsh doesn't have a lot of time because he'd only been there for a short period of time to make any significant changes. However, we know he doesn't like forward guidance. And so there are usually sentences in there about members thought that perhaps there was no reason to raise interest rates now, but it could be happening later. That kind of stuff might disappear. So that'll be what Wall Street is watching right now to see how the minutes might change as opposed to how policy might change.
Mike, before you go, you're in Jackson Hole. Is Kevin Warsh going to Jackson Hole in about 6 weeks' time?
Well, we don't know for sure. The Fed never confirms it until the last minute, but we assume he is. But I think this year, people might be disappointed in his appearance if they're thinking he's going to make any big monetary policy pronouncements. Since he doesn't like forward guidance, he may return to the tradition here of just basically commenting on what the subject of the meeting is rather than anything in particular about what the Fed's going to do going forward.
Interesting. We'll see. Mike McKee, thank you. Appreciate it. Enjoy yourself, Mike. Mike gets the good trips, doesn't he?
He always gets these beautiful places.
It's not bad, is it? Jackson Hole once, Jackson Hole twice.
Yeah, I mean, honestly, it is interesting to see the choice. You know, it's sort of Sintra in Europe, which is a little bit more built up, and it's more the rugged sort of classic Americana with grizzly bears out in the Grand Tetons. Look, you asked a good question, which is, will he show up, and then what will he actually say?
Yeah.
And at a certain point, if he doesn't give, and I'm talking about Governor Warsh, Fed Chair Warsh, if he doesn't give his view of exactly how he sees inflation or how he sees the employment market or anything at all to guide markets, markets are going to take a real response from that. I mean, at a certain point, he has to give some commentary because he's had enough time to say something. Ultimately, it goes down to, he said he would only say something when he had something to say. Yep. If he never has anything to say, people in markets are going to take the job for him and they're going to run with it. And the people who do have something to say are going to suck the oxygen out of the room.
In the meantime, maybe that's what he wants, you know? Maybe he's happy with where markets are priced at the moment. Certainly hasn't pushed back. And that ultimately is the problem. The less you speak, the more weight people put on the things you do say. So he goes over to Sintra, Portugal and states the obvious, that inflation expectations have come in over the last few weeks. I mean, that's just stating the obvious. But people say, oh, he chose to say that. Didn't say much else. Why did he choose to say that?
I saw the headline come across, and then I saw the bond move reaction.
Right.
And I was thinking, who could objectively look at the price action and not say that? At a certain point, you start to wonder whether that is the indication or whether that is what he wants, whether he's trying to avoid the hot seat with President Trump, whether, you know, we get any insight into these conversations. I don't know that we're going to get much insight into the family fight this afternoon.
2 p.m. Eastern Time, Fed Minutes drop. Look out for that this afternoon. Let's get you an update on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Maine's Democratic Party urging Graham Plattner to immediately withdraw from the U.S. Senate race following allegations of sexual assault. The party vowing Plattner will have no role in selecting his replacement, accusing his campaign of trying to influence the process. In New York City, officials are reopening some streets around a compromised Manhattan high-rise. Emergency crews are working to stabilize the structure. The building was evacuated Tuesday after construction workers reported buckling columns and sagging floors. Blue Origin is set to be raising $10 billion at a $130 billion valuation, excluding new funds. The New York Times reporting founder Jeff Bezos is contributing $2 billion to this latest round of funding. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update and thanks for this morning. Up next, we'll set you up for the day and the week ahead. Plus, we'll catch up with Scott Chronert of Citi as the rotation in stocks opens the door to what he sees as new opportunities.
The best question is, can the market survive if the AI trade in general falters? And the answer to that, I would have said, will say, and will always argue, is no. Until then, it's just the water sloshing around in the pool without any coming over the edge.
A rotation within the market, not out of the equity market. Dan Greenhaus of Solus doing his best to ask himself, his own questions a little bit earlier on this morning on the equity market, right?
He did a great job asking himself his own questions. As far as the sloshing around water, yes, although the bathtub is getting bigger and bigger, and it's unclear whether there is enough water to go in. A lot of people are saying, yes, it is. And then a lot of hyperscalers and semiconductor companies are saying, hold my beer, and let's raise some more.
Equity futures this morning, negative by 0.5 on the S&P. Recovering on the Nasdaq. We were down by more than 1% earlier. We're now down by 0.7. In the bond market, talked lots about this move in yields, not stateside, but worldwide. Up by not even a basis point on a 2-year in the US, but up to close to double digits earlier on this morning in the UK and Germany. In the oil market, that sets the tone for the market earlier on this morning. We're up by 4%, 73 on WTI. Brent crude at 77. Looking ahead, the day and the week ahead looks like this. Later this morning, the president holding a press conference from NATO, so look out for any comments regarding Iran coming out of that. At 2 p.m., the Fed releasing the minutes of its latest meeting. Now, typically, maybe you wouldn't be that interested in Fed meeting minutes, but this is the first edit for Kevin Warsh, new Fed chair. Be interested to see what kind of edit we get from the man at the top of the Fed.
People sat in chairs. They spoke. They looked at each other. Coffee was had. Thank you.
Right. Just one page.
That's it. That's the whole statement.
I'll be opening the PDF a little bit later on this afternoon. Looking ahead to tomorrow, another round of jobless claims on Friday, earnings from Delta, and a much anticipated SK Hynix ADR trading debut stateside. Look out for that. That company raising $28 billion. Let's talk about the equity market and the tech trade. Stocks pushing lower this morning into the opening bell. Equities already unwinding the tech trade and now facing the collapse of the US-Iran ceasefire. Scott Chronert of Citi writing, until we get some fundamental clarity, especially around the AI build-out, we suspect rotation and choppiness will linger. However, we believe this creates an opportunity for less crowded trades. Scott joins us now for more. Scott, welcome, sir. It's always good to hear from you. Recently downgrading tech, so I think that's where we should start. Why the move away from tech?
Well, I think it's pretty clear. The way we were looking at it is that the setup with the strength that we saw in Q2 on the memory storage component of the semiconductor space really began to set up for a face-off. Where is this going to lead us as the hyperscalers have to contend with the influence of rising input costs into their CapEx calculations? What this did, in our view, is set up a situation where the strength we saw in Q2 for that semi-hardware component, we felt was somewhat unsustainable relative to where the hyperscalers' CapEx considerations are right now.
Scott, with that in mind, is that a market where the hyperscalers can start to pick up? We've heard lots about a rotation away from chips, from hardware back to the big spenders. Do you see it the same way?
Well, I think it's going to be tricky. I think the way we're looking at it is that the Q2 reporting period is going to tell us a lot on this. I don't know that the hyperscalers can back off just yet in terms of their CapEx plans, and nor do I think they should necessarily. But what you have is this ongoing friction where the market's going to be looking for evidence on the ROI discussion for the hyperscalers. And the burden of proof on that, I think, is going to be the mission critical component on the way this plays out. So we've remained underweight the media component of communication services, downgraded, as I mentioned, semis and hardware, but we did lift software from an underweight up to a market weight. So there we think that there's an opportunity for the software component of this to be a sort of a tertiary beneficiary of some of the pressure we're seeing now on semis and the hyperscalers.
Scott, how do we get to 8,100 without the participation of the tech behemoths?
Yeah, it's a really good question, Lisa. So when you look at this, the Mag 7, and I would say first up front that we think the Mag 7 construct is dead. We think it's gone. We've gone to Mag 8, and we could probably go to 9 or 10 if we really wanted to in terms of the way some of these memory semiconductor-related companies have appreciated of late. But the path here really requires two things. Number one, you need the broadening effect to kick in. That other half of the market that's not attached to AI, that's more traditionally macro and economically sensitive driven, we think that is where there's opportunity right now. But number two, to your point, the Mag 7 coming back to the construct I think is dead, has essentially traded roughly flat year to date, and that's 40% of the index. So we do have a setup here. We're going into the second half, and we got roughly 6 months to go. Is this broadening effect to take hold on one hand as we wind down Iran, which I know is back in the news flow this morning, but as oil prices fade, we think that takes pressure off of inflation. But then as you go further into the year, we do think there's opportunity for the AI trade, once it digests a lot of these issues that we're contending with currently, to kick back in, and the combination of the two is how we get that sort of mid to upper single digit move into the end of the year.
Scott, you mentioned the Iran situation, and we are seeing a flare up this morning. At what point would oil prices rise to a point where you would think that the broadening out trade was threatened, that this thesis of disinflation into the end of the year truly gets undermined?
Yeah, I'm not sure there's a magical level here, Lisa, but what I would say is that, obviously with oil sub 70, we were feeling pretty good about our broadening play, right? And I still think that's our base case. We're a day or two into the conflict sort of reasserting itself, so we'll need to let this play out. But I'd say if there's a line in the sand on oil prices that we've been drawing, it's probably around that $80 level that really begins to kind of clip the thesis for us.
Not too far away right now. Scott, it's good to see you. Thanks for the update. Thank you, sir. Scott Chronert there of Citi, downgrading tech recently, but still looking for a market to end the year at 8,100 on the S&P. In many ways, you asked the right question, which is, can you get to 8,100 if the tech story is not participating in quite the same way?
And the answer is, well, the tech story will eventually participate. First, there'll be the broadening out, and then you might see some of the tech stories start to perform. Of course, the idea of the Mag 7 story being dead is something that an increasing number of people are coming around to. And frankly, what we're seeing right now with a real distinguishing between the hyperscalers and the semiconductor names and a whole host of others.
Happening right now in Ankara, Turkey, this development at the moment, the president in a bilateral meeting right now with the Ukrainian leader, saying it's a great honor to meet with Zelensky and that the two have developed a good relationship. The tone for this meeting very different to the tone in the Oval just a few years back.
Yeah, and I believe that Volodymyr Zelensky has been seen wearing a suit around the NATO meetings. He's learned his lesson when it comes to discussing anything with President Trump. There will be a real question about what materials, what weapons, what types of aircraft is the U.S. willing to supply to Ukraine, and what kind of promises will be made in tandem with other NATO members as other NATO's members pledge to support Ukraine through 2027.
Such a crazy moment for this market right now, for geopolitics to reassert itself. In many ways, the chip rally started not despite, but because of the war in Iran. It focused people's minds on the things that were working. Chips absolutely ripped. Now it reasserts itself just as chips start to roll over following a 90% move. It's an odd one.
Are valuations too high for tech names to be the haven that they were at the onset of the Iran conflict? And ultimately, the answer is, we don't know, because we've heard about it all morning. Some people saying, yes, it still is. Other people saying it's more complicated now. This is a maturing story.
Coming up tomorrow, we'll catch up with Bob Elliott of Unlimited Funds. We'll speak to David Lebovitz of JP Morgan, Vito Spaduto of RBC, Michelle Weaver of Morgan Stanley. All of that and more coming up tomorrow. With equities recovering just a little bit, we're down on the S&P by 0.5. From New York City this morning, good morning. This was Bloomberg Surveillance.